Sarah, Sister Hora, I think we should start. It's nearly 90 participants now. I think we have 400 plus registrations, but maybe it's already past 10. I think it's better if we can start.
Yes, brother. Sure. Bismillah ar-Rahman ar-Rahim. Distinguished participants, dear colleagues, Assalamu alaikum wa rahmatullahi wa barakatuh. Wassalatu wassalam ala nabiyyina Muhammad wa ala alihi wa sahbihi ajma'in. It gives us a tremendous pleasure today to welcome you to this public hearing session on the revised exposure draft of AUP Financial Accounting Standard 29, Sukuk in the box of the originator. This event is held in collaboration with UAE Banks Federation. We would like to thank them for taking the efforts and extending their support in organizing today's public hearing. The public hearing is one of multiple steps in standards development process at AUFI and represent an opportunity for us to interact with and benefit from the knowledge, experience, and wisdom of professional individuals and experts from all corners of the industry on the newly issued exposure drafts. Today's revised exposure draft on AUFI FAS 29, Sukuk in the box of the originator, prescribes the accounting and financial reporting requirements for the accounting treatment with regard to the Sukuk originated by the Islamic financial institutions or other institutions. It also deals with the presentation and disclosure of Sukuk issuance in the box of the originator with regard to its structure. Now, and without further ado, let me invite to the virtual floor the Secretary General of AUFI, Mr. Umar Mustafa Ansari, who will present the exposure draft and walk you through its main content while answering time to time your questions in an interactive session. Brother Umar, the floor is yours.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Thank you very much, Sister Hora, for the brief introduction. And thanks to all the distinguished participants for being here today. Thanks to Emirates Banking Association for supporting the initiative. This standard that we are talking about is one of the most important standards that we ever developed. Again, every important standard has its own significance, but some of the standards have far-reaching effects. In 2015, AUFI started a very comprehensive sort of project on developing standards on Sukuk, addressing the new challenges, new issues, new type of products and structures that we can see in Sukuk. And we decided initially to develop accounting and Sharia standards. And then we added the governance standard to that as well. Since 2015, we have developed multiple standards in this area. You might already be aware that we already developed our FAS 33 and FAS 34. FAS 33 on the investment in shares, Sukuk, and similar instruments, which was a revision of FAS 25 earlier. We issued FAS 34 on the financial reporting for Sukuk holders. That is one of the very significant elements of Sukuk reporting, which was missing in most of the markets. This standard, FAS 29, was first in sequence out of that, and that is addressing one of the areas where we did not have a standard earlier. That is the financial statements in the book of the originator. In 2017-18, we were very close to finalizing the standard, and actually we finalized the standard at one stage. But it was decided by the Sharia Committee of AUFI. Now, this Sharia Committee, just for those who are new to our standards and who don't understand the whole standard setting process at AUFI, I would like to summarize that all AUFI's accounting, auditing, governance, and ethics standards are also subject to a review by a committee of the Sharia board that actually reviews these standards to make sure that these are aligned with the Sharia standards of AOFI, and to identify any gaps or any issues that are related to Sharia in these standards. Since the Sukuk standard on Sharia side, which was also part of the same comprehensive project, was also being developed at the same time, and there were some cross-referencing issues. Even if you don't put an actual cross-reference in the standards, but you need to see the treatments that are appearing on both ends, from accounting and Sharia end. And that is the reason that always we say that some people at times have a confusion that AOFI Sharia standards alone, their adoption might be sufficient, while we believe that the whole set of standards is presented as a bouquet, which complement each other. So Sharia standard and accounting standard, particularly in this area, complement each other to that significant level that the Sharia committee suggested to delay the issuance of this standard, which was already given a number as FAS 29. So we decided to delay the standard. The delay was linked to the issuance of the exposure draft of Sharia standard. Last year, actually year before last year, when we were actually finalizing the Sukuk Sharia standard exposure draft, that is 2022 December of that time, we issued this exposure draft again after some improvements in line with the exposure draft that was already being developed, and taking into consideration some other issues that were addressed, like, for example, in the then standard and other standards on the Sharia side. So we issued this standard in December 2022, but we decided that the public hearings on this one will not be conducted very quickly. Rather, we'll be waiting for the Sharia standard, which in the last year has gone through again another round of review by the Sharia board and the respective committee. And now what we have in place is that this standard is also subject to finalization, and we are holding the public hearings. And also on the Sharia standard on Sukuk, which is very comprehensive. Most of you might be aware that we have already conducted public hearings on that one. On this one, we also conducted a roundtable during 2023, I believe. And 3 public hearings were held between 2017, 18, I think. So effectively, we have already gone through significant market update and input process on this standard already. But this is I would say the final round of that. Now, with this standard being finalized and the new Sharia standard being finalized on Sukuk, we'll be completing our project, which included actually 5 standards, that is 3 on accounting, 1 on governance, which is already final, 1 on Sharia, and this one are in the exposure draft stage, and inshallah will be finalized within 2024. We also have issued another standard recently, last year. That is the final standard issued last year. Exposure draft was issued in 2022. That is on Sharia compliance and fiduciary rating for Sukuk and similar instruments. So that even the Sukuk related rating part we have already considered. So if we combine them all together, it becomes a package of 6 standards. And again, since Sukuk have so many products, different type of products underlying them, so it is even quite possible that some of the issues are not addressed in these standards, but are rather addressed in other standards, like the issue of tradability is addressed in the then standard. The issue of the underlying products are referred to in the respective product related accounting and product related Sharia standards. I have taken a bit time on giving you a bit of background about this comprehensive project, and here it is also important to understand the approach toward this standard. The Sharia standard that we have issued on Sukuk is quite detailed, and we have tried to cover maximum structures and maximum issues there in one go. But this standard is comparatively, a bit short and concise standard. It is more of a principle-based standard, whereby the transaction structures and the respective accounting of the underlying product is not discussed in this standard in too much detail, rather has not been a subject of this standard. Rather, this standard addresses the main issues of classification and main issues related to accounting of the structure of the sukuk, and then it leaves the underlying asset accounting to the respective underlying standard. This is like, just a brief about this standard, and then I'll take you through the standard. Before that, I would like to mention a couple of things. Number one, this is the public hearing that we are conducting in English. There will be public hearing in Arabic also. I think we plan normally for each standard 3 English public hearings and 1 at least Arabic public hearing. The public hearings on the Sukuk Sharia standard are also happening, at least one of which will be in English and others will be in Arabic. So you need to just keep an eye on the emails that you receive from AOFI, and those who are particularly interested in attending, because some of the public hearings in respect of Sharia standard will be physical. I think one of the most important, because we are working with EIBF on this one also. So I think the Emirates Banking Association with this one also. So I think this will be very important for some of you to attend the Sharia standard public hearing and physically being held shortly in the UAE. I think the date and others are being finalized. Maybe the email and the invitations will be launched soon. So if those of you who want to attend, please approach the AOFI Secretariat so that you are not missed out. The mails will be sent to all our important groups. But since it's a very important event, it will be good if you can get yourself enrolled in advance for that. With regard to the Sharia standard English public hearing also will let you know. So those of you who are interested in that one also, please, if you can send your send emails to the Secretariat so that your names are not missed out from the invitation. The English one probably will be online one like this one. Now, what is the way forward? What we are doing, we are completing the public hearing process on this standard, and we'll wait some time for having some input on the Sharia standard, and probably it will be finalized simultaneously with the Sharia standard or maybe before that, but we plan it to be finalized within this year. For those countries who adopt AOFI standards, some of the drastic changes might be brought in the accounting and financial reporting practices by this standard, and that is why we would highly appreciate receiving maximum comments from the auditors, the regulators, and the preparers on this standard. This is something that is going to impact you. I can tell you that once it is applicable officially in your countries, some of the sukuk may be considered off balance sheet, which currently are being considered on balance sheet. Some of the sukuk may need to be changed, may need to change their classifications. For example, instead of having a classification of liability, they might need to be classified as equity. A couple of disclosure requirements, but significant disclosure requirements, couple of accounting treatments that all might need to change. Some of the accounting policies might need to change. So it is always good to be prepared. So our request is that provide your maximum comments today by this interactive session, or you can provide later as well. We can see a lot of people, actually around 110 people have joined in. So welcome to those who have joined later. Before I move to the presentation, just would like to mention that in the chat window, I can see people are there, but there is no question answer in the Q&A tab now. Just a request that whenever you want to put a question, please put in Q&A tab, and we'll try to accommodate each and every question. Even if because of limitation of times we are unable to address all the questions, still we keep record of each of the question and comment, and it is taken to the working group. Again, I would clarify one thing that most of you who always attend our public hearings know, but just to mention that any comment that you provide is valuable for us. We take it to the working group and to the board. If I provide an answer, if I provide an explanation, that is actually us, just to explain the view of the board and the working group. So it is not that in any manner when we respond to you about a comment, it does not mean that your comment is being ignored. Even if we disagree with your comment, the comment will be taken to the board and the working group, and then it's obviously up to their prerogative as to how they consider it on merit. So with that, I'll share my screen now. One question that everybody asks every time about the presentation. The presentation is actually just a version of the same standard that is available on our website in the PDF format. So we normally don't provide the presentation. May I request Sister Noof and Sister Hora to somebody to put a link to the exposure draft PDF version in the chat window. So anybody who want to have access to that, they can have access to it. Thank you, Sister Noof. I can see that. With that, now I'll take you through the standard, not the presentation. As I mentioned, it is the standard itself. Only we just made it like, in a presentation form to make it legible. Any comments about the overall project? Any comments or questions about the overall project, about the approach, about the background and frame and summary that I have provided? Please feel free. Just one more thing. Anybody who want to raise their question by voice and video, they are most welcome to raise their hands. If the time permits, we will allow them, inshallah, to speak up and open up their mics and videos. But if for any reason, mainly the reason of time being limited, we are unable to address that, still I'll try to address every question that come in Q&A tab. So please don't put anything in chat window, put the questions and comments in the Q&A tab. Sister Saira and Sister Hora, I think just a note for ourselves that reference to Sharia Standard 17 need to be updated. Okay. We'll mention it with both, even if as soon as the new one is there. And normally our Sharia standards don't have an effective date; they become effective immediately. Okay. So some of the things that are related to the preface and introduction, I have covered them in the background that I have provided to you. So I will not be staying here, but we can take any comment. If anybody has a comment on introduction or preface section, please let us know. Otherwise, we'll move ahead to the standard. Okay, with that, we come to the objectives of the standard. The objective of this standard is to prescribe the accounting and financial reporting requirements for the accounting treatment with regard to the Sukuk originated by the Islamic financial institutions, the institutions or other institutions. This standard also deals with the presentation and disclosure of Sukuk issuance in the book of the originator with regard to its structure. Those who have reviewed the earlier exposure draft also, they will find one major difference. The first exposure draft of FAS 29 was issued with the name of Sukuk in the books of the issuer, and now we have changed it to Sukuk in the books of the originator. After some discussions in the Sharia side, on the governance side, and then on the accounting side, it was decided that at times the issuer of Sukuk is the SPV and not the originator itself. A common word that is used by the market, that is obligor or financee, we avoid those words, particularly the word obligor that is more common in the rating and legal side. We reviewed it, we evaluated it, and for the conscious reasons, we decided not to use the word obligor. Reason is that while some of the Sukuk may be considered a liability, as we will go through this standard, but principally speaking, Sukuk actually represent an underlying a proportionate right on the underlying assets or business. So from that perspective, it is not an obligor, rather an originator who actually is the what you can say in like slang words like the beneficiary of the sukuk or the financier of the sukuk. But technically speaking, from Sharia standpoint and from the legal and accounting standpoint, he is not an obligor, because not all sukuk are liability, or rather very limited number of sukuk actually become a liability from the standpoint of AOFI. I would like to clarify one more thing, which I have clarified most of the time with the accounting standards public hearings, that all AOFI standards are read with respective Sharia standards, which means that we do not intend to develop accounting standards for products and services that are not specifically addressed by Sharia standards, or if they are not complying with the requirements of AOFI Sharia standards. So this is always the one that I referred above. That clause is always there, that actually clarifies that there is a relationship between accounting standards and the Sharia standards, and the Sharia principles and rules, which mainly comprise of AOFI Sharia standard, are important to understand the standard itself. So from that perspective, while a very limited type of sukuk may be considered an obligation or a liability, as we call liability type sukuk, but a combined term or a common term, consciously we decided that we will not be covering it as an obligor. I would also like to mention that those who are interested in understanding these differences may also need to see the Sharia compliance and fiduciary rating for sukuk and other similar instruments, other Islamic finance instruments standard that we issued on the governance side, that actually identifies some of the attributes related to different type of sukuk, and that actually clarifies as to how and to what extent they are having the liability element or having more of a governance and asset maintenance element. So from that perspective, this is something important. A note for our team, Sister Saira, the first sentence for the accounting treatment for accounting and financial reporting requirements for the accounting treatment, I think we need to see this sentence in line with the new writing style. Only the new writing style, I think there is, the way we simply say accounting and financial reporting requirements with regard to sukuk originated by this. I think normally we keep it concise. So accounting treatment here again might not be needed. We'll just see it in the working group as to whether it's needed or not. I can see a question in the Q&A tab. Brother Omar Al-Alusi, Assalamu alaikum wa alaikum assalam. You have mentioned changes may happen and some of sukuk may be changed from on balance sheet to off balance sheet. Is there any further analysis for impact on investor interest? Is there a problem or notice period communication to investor holders and issuers? Brother Omar Al-Alusi from Sultanate of Oman. Thank you very much, Brother Omar, for being here with us. Thank you very much for an excellent comment you have raised. Can you kindly allow me to reach that place where because it might be, I highly appreciate, I can see that you have read the standard before actually coming here and you understand the impacts of some of the significant things. Regarding the probation or notice period communication to investor holders and issuers, these are the issues and challenges related to Sharia and governance side. So we have covered these issues in the Sharia and the governance side. But the classification part, as to how it changes and what will be the impact, that we are going to discuss in a bit later. So I will inshallah be discussing that one. I would like to mention that any changes that have an impact, so changes in the sukuk, changes in the sukuk structure and material information, all these things are covered in the governance standard already. And some of the requirements are covered in the Sharia standard exposure draft. So that part that you raised is technically not an accounting issue, but a governance issue. Let me clarify one thing. I think it's very important for us to understand. Accounting just reflects what has happened. Accounting is the reflection of the business facts. When we talk about AOFI standards, we are talking about reflection of the business facts in line with Sharia principles and rules. So when we are talking about a change in this classification or anything, we are talking about something that is reflection of what is actually happening on the ground. So accounting never asks you to do something in a specific way. Accounting just asks you to reflect these things in the financial reporting in a specific way. Now, this becomes two different things. So first thing is, Is this change happening because of accounting? Maybe it may not be actually happening because of accounting. It may be happening because there is something on the back end that actually asks for reflection on a different basis. Further discussion, we'll have it later, but accounting normally does not address then these governance issues like probation or notice or communication to investor and insurer, which are governance issues. But it is a very good point, sir. We highly appreciate it. And we'll try to address this thing that if it has having an impact on the investor interest and then in the information need of the stakeholder, do we still need to address it somewhere in the standard or somewhere in the guideline or in the base of conclusion? So maybe we'll provide some answer to it, inshallah. It's an excellent comment. Further about classification, we'll discuss a bit later. Brother Zabihullah Rasikh has said, Assalamu alaikum wa alaikum assalam, but brother, I can't see your question, so waiting for that. So in the meanwhile, we can move ahead. Now coming to the scope. This standard shall be applied for accounting and financial reporting for the Sukuk in the books of the originator. Now, one thing, let me take you back to the objective. We said Islamic financial institutions or other institutions. So it means that that is why I said that this standard may have more far-reaching effect as compared to some of other AOFI standards. So, for example, who are the Sukuk issuers? So Sukuk issuers or originators are not always Islamic banks or financial institutions, or rather the majority of them are not Islamic financial institutions. So Sukuk are issued by the governments, by the quasi-government and semi-government bodies, autonomous bodies, corporate entities, and obviously Islamic financial institutions, and even some Islamic financial institutions who are not Islamic banks. So considering this factor, this is a very important issue that you need to address, that AOFI's scope of standard setting applies on Islamic financial institutions, but also addresses Islamic finance transactions. So this is an area where this standard actually has far-reaching effect, more than actually the effect on the Islamic financial institutions, because we may not have any numbers available right now, but we can simply say that the vast majority of Sukuk originators are not Islamic financial institutions themselves. And from that perspective, it becomes very, very crucial and very, very important that we consider this as how would I would say that consider it a far-reaching and multi-dimensional standard that applies on institutions other than Islamic financial institutions as well. This standard determines the requirements of primary accounting treatment, presentation, and disclosure of Sukuk in the financial statements of the originator. This standard does not okay, before going to that, it requires in the originator, but also we have FAS 34, which says that you need to do the financial reporting for the Sukuk holder also. Now, this is something very crucial. Sukuk are not conventional bonds. Or maybe, as I say every time, Islamic finance is not exactly same as conventional finance. And if it was the same, it was never needed. I always say this argument, that Islamic finance is not always the same. If it was the same, it was never needed. So since the structure of the transaction, the risk and reward of the transaction, the linkage of the returns of the underlying assets and the value of the underlying asset, all these things have different attributions as compared to a securitized borrowing or securitized bond that is there on the conventional side. So considering all these factors, we need to keep in mind that Sukuk are, to be honest, a different animal or a different fruit as compared to the conventional bonds. So you cannot just apply apples to oranges in the same way, and rather we at times say that even people a lot of time talk about the uniformity of financial reporting and all that, comparability and uniformity and all that. So I think even the IFRS accounting framework and AOFI accounting framework address this issue, you know, the comparability does not mean uniformity. Means that you cannot compare apples with oranges, like, you know, in a exactly similar manner, because maybe both of them may carry a different risk structure, they may carry different risk profile, they may carry different types of returns, different situations with that may arise. One of our scholars, you know, he always say this thing, that if you want to see the difference between Islamic finance and conventional finance, just put the asset on fire. Means hypothetically, you put the asset on fire on every stage of the transaction, and then you will see how this transaction is different from the conventional transaction. So while in like, you know, in normal scenario, a sukuk may work exactly as a bond, and you may not find any difference in cash flow or anything. But when you come to the risk profile of the transaction, and when you come to the structure of the transaction, when you come to the underlying contracts and products of the of the structure, and when you come to adverse scenarios, most importantly, you will find that sukuk are not exactly the same. And this is where we have the challenges, and this is where we need this specific accounting. I can see a couple of questions coming up. There is a comment from Brother Fahmi Siddiqui. Salam, sir. I would like to know the conformity of UFI standards with IFRS 9, and some jurisdictions in GCC still follow IFRS. Brother Fahmi Siddiqui, excellent question. Walaikum assalam, and thanks for your very important comment. As in a nutshell, UFI believes that Islamic finance risk profile, the structure, the underlying asset related linkage of the products, and the product design itself at time require different accounting. So IFRS 9 is an excellent standard, but it has not been developed for Islamic finance. This we need to understand. It does not address Islamic finance primarily as a different structure, different ball game. Secondly, the issue of substance over form is always creates confusion, because a lot of things people say that, okay, your product documentation is different, but in substance you are doing the same thing as the conventional is doing. And here we have a difference opinion, and we believe and we say that, Nauzubillah, you cannot make fool of Allah subhanahu wa ta'ala by just having a different bunch of papers. So when you say that this is something halal because it has a different bunch of papers, so it is not sufficient to say, oh, we made this bunch of paper to please Allah subhanahu wa ta'ala, and then we do whatever conventional is doing. So the point is that if you are doing the Islamic finance transaction in its real true nature and real true substance, should not be different from the legal documentation. So we do not believe in hypocrisy, that the documentation is different and the transaction is different. No, we believe that when we talk about Islamic finance, we have all the responsibility of fairness first towards Allah subhanahu wa ta'ala, and then towards all the stakeholders who are involved in the transaction and who are interested in the financial reporting of the Islamic finance institution. And from that perspective, we believe that we need to have our own standards in these areas. So with regard to IFRS 9, if you allow me, IFRS 9 addresses three major aspects. Maybe I'll expand that, maybe up to 5 aspects. So first aspect of IFRS 9 that we talk about is recognition and measurement on the asset side, that we have covered in different standards. Our recognition of measurement in AOFI standards is considered in different standards, but particularly with regard to Sukuk and Sukuk type instrument, the recognition and measurement part for the asset side is in FAS 33, while on the what we call liability side or the originator side, that is this standard that we are talking about. So it is going to partially take precedence over IFRS 9 from AOFI's perspective. That is one. The IFRS 9 has one area related to derivatives and hedging, for which we have our standard on Wad, Khayar, and Tahawut. financial accounting standard on that was issued earlier. We have the general recognition and measurement of different type of instruments, which we have covered in different standards. Some of the disclosure requirements of IFRS 9 read with IS 32, including the classification part, are addressed in our standard number 1, FAS 1. And some of the requirements are addressed in the quasi-equity standard and the control standard, which have been issued more recently. In December, we have finalized them and issued the final standards. So in a nutshell, IFRS 9 has different aspects, and considering the different, okay, let me just say one thing. For conventional banking, you can call them 100 different products, but actually there is only one product, that is money on money. That is interest. But so there can be 100 different products, but they all fall in money and money. And that's why IFRS 9 talk about financial instruments or debt type as anything that has a principal and interest. While from our perspective, all transactions cannot be classified in a single manner, because we replace the conventional transactions from the conventional interest-bearing transaction, and we replace them with either of the sale-based transactions. Even they can include deferred delivery sales or deferred payment sales. Then we replace them with lease-based transactions. We replace them with participatory and investment instrument-based transactions. We replace them with services-based transactions. So for us, the transaction of conventional, which is only money on money, which is haram for us, it is replaced with these all transactions. So from that perspective, I'm happy that you opened up this debate so that we can actually open up the discussion in this aspect, that why different accounting treatments that AOFI is identifying in these areas are very important and crucial, not only to for the accounting purpose, but also for the Sharia compliance and the transparency and the fairness purposes that we have. So from that perspective, as I mentioned, so these all aspects of IFRS 9 are now covered in different AOFI standards. Once this standard is finalized, from our perspective, we would have covered 100% of IFRS 9 in different standards for sure, not in one standard. But IFRS 9 will be a project of AOFI. That was our internal purposes when we made the plan like 7-8 years back. So this all will be covered. So thank you very much, Brother Fahmi Siddiqui, for your comment and for allowing me to respond to this thing in a bit detail. I think this whole discussion that I mentioned is very much important for the perspective of very much important for the perspective of not only the financial reporting, but also the Sharia compliance. Brother Zabiullah Rasikh has a comment that how to make sure that investors that the Sukuk is complete in terms of Sharia. Brother Zabiullah, you raised an excellent question. So for us, as I said earlier, that we present the whole concept of an integrated set of standards. So our Sharia standards provide the actually, at time, I would say that all AOFI standards are Sharia standards. It's not that our accounting standards are not Sharia standard. Actually, they are converting the Sharia rules into accounting principles the way they need to be reflected. So if you have the Sharia standards, which define the products and services and their respective type of, the terms and conditions, the requirement that should be there. That is the centerpiece of Sharia compliance. But then you can have the best, you can have the best rule book. But if that best rule book is not implemented on the ground, you cannot get the results. It will be just on the shelf. So for that, we have our governance standards that provide the governance structures and controls to ensure that these Sharia standards are implemented in a proper way. And then for the fairness and transparency of this Sharia compliance, that is your challenge that you have raised in your question. If for this purpose, you need to have fair and transparent financial reporting and additional reporting requirements or on transparency and disclosure for the purpose of the benefit, for the purpose of the Sukuk holders and or the prospective investors. And from that perspective, the financial accounting standards that we develop, along with some of the additional transparency and disclosure requirements which are in the governance standards, they serve this purpose. Then we have the standard on the ethics, where we say that you need to, all these principles should be, because ethics is the spirit. The paperwork is the form. Ethics and the values are the spirit of the transaction. So we then apply the ethical standard. Then we have the auditing and Sharia auditing standards, and we require that financial reporting for Sukuk holder and this financial reporting for the originator both should be subject mainly to the Sharia or to the financial audit, and some of the requirements are to be addressed by the auditor to address that. And this, in some situations, we have recommended for some public instruments, we have recommended that a Sharia audit of the instrument should also be there. The whole governance framework, including the presence of a Sharia board and the Sharia compliance function on that, and the minimum meeting the minimum requirements that are contained in our Sharia in our governance standard. Even the Sharia standard exposure draft that you will see has touched upon some of the significant governance aspects, although the governance standard that we have developed is quite detailed. Considering all these things, still you will need the financial reporting by the originator, and you will need the financial reporting of the Sukuk entity itself. That is that standard that, as I mentioned, we have already issued a financial reporting for Sukuk holder, where the Sukuk holder should know that he has not just invested money in money, rather he should be having an information about financial reporting for the Sukuk holder form, that he should have a summarized financial statement of the performance of the underlying asset. This is where, if we believe, is your question is addressed in this way. We believe, again, nothing is perfect. Everything can be improved over a period of time, but we highly appreciate the questions that are raised by you and Brother Fahmi Siddiqui about this issue, because this is like, this difference with IFRS 9 and why we are doing this thing and why we are emphasizing on this part of, because we believe that even without this financial reporting element, your Sharia compliance is not complete. I'm going to address some significant issues about that, but let me put one example. In the Sukuk document, you say that you sold the asset to the Sukuk holder. But then when you do the accounting on the conventional basis, you don't put that asset off balance sheet. So did you sell it or did you not sell it? That is the question. If you say that I sold it, then how you can keep it on your balance sheet? Can it be happening anywhere in the world where you sell something and you still keep it on your balance sheet? No, it happens only in Islamic finance, because we have some very intelligent people who say that Islamic finance is no different from conventional. I'm sorry, I don't want to criticize people personally, but my point is this whole approach of having this mindset that, okay, we just did a bunch of papers to make fool of people, because you can't make fool of Allah, so you can make fool of people. So we made a bunch of papers to make fool of people, but we did not sell the asset. So the question is, did you sell it or you did not sell it? I'll address this issue later when we address the off-balance sheet and the control issue. So I'll come back to this point. We have comment from Brother Sayyid Imtiaz Abbas, who said, how originator of Sukuk get trust of Sukuk holder about using Sukuk funds in Islamic way on balance sheet? Brother Imtiaz, I think partially we have answered your question, but I will try to answer it more specifically going forward when we talk about the disclosure requirements. But from our perspective, as I answered to Brother Zabiullah, that all these standards combined can get the result. Only Sharia standard adoption cannot get that result. So thank you very much for your comment, and thank you very much for attending. Thank you very much. Okay. Okay. There is a comment from Brother Jeffrey Youssef. Are Sukuk derivatives? If yes, what's the difference of derivative in conventional finance and Sukuk? Brother Jeffrey, when I talked about derivative, I was not referring to Sukuk. For us, our Sukuk are not derivatives. Although Sukuk, from the conventional definition, may include some options which can be considered as derivatives, but we have kept that option in accounting, that if such type of derivative option or what we call promise, that is wad or khiyar, is present in the structure, that can be considered separately as a equivalent to derivative. We don't call it derivative. We simply say wad or khiyar are to be accounted for in line with different standards. So I'll come to this point. So it is very clear that Sukuk are not derivatives. Very, very clear. Sukuk are not derivatives. But what happens that some Sukuk include a promise element or an option. The promise element and the option that are embedded in the Sukuk structure at time may meet the definition of a derivative, but those are for sure Sharia compliant promises, and that is WAD, and options, that is khiyar, which means that they are to be addressed by our standard on options and khiyar. In some situations, these options or these options or these promises or undertakings, they become onerous, means that they are more likely than not to be exercised. In that situation, we have said that a provision should be made against that. So we'll come to that, inshallah, as we move ahead. Okay, so I think I addressed your question already, but I'll come back to that further detail when we reach there, inshallah. Next comment is from Brother Zukhruddin Salihuddinov. Assalamu alaikum, Mr. Umar. Wa alaikum assalam. Per standard, I think most of the Sukuk issued and related assets will be recorded off balance sheet. Is there any option to produce combined financial statement with combined consolidated financial statement of originator or SPVs? Basically, is there any option to produce two sets of financial statement? One is originator financial statement according to OFI and combined report for internal external users. Thank you. Thank you, Brother Zukhruddin, for an excellent question. It is, to be honest, it's an excellent question and highly appreciated. But the only issue is that if I try to answer this one right now, some of our participants may miss out some of the points, because I can see that you have, mashallah, read the standard and have come to a very important point. So from that perspective, when we reach there, I'll try to answer your question. Next comment is from Brother Sheikh Muhammad Isa. Brother, the Sharia compliance is having a Sukuk underlying asset on balance sheet at the SPV. This can be done whether a sale undertaking, legal transfer of asset from the originator to SPV. Am I correct? This is because in some jurisdictions, sale of asset from originator to SPV isn't legally allowed, especially for government assets. Brother Sheikh Muhammad Isa, excellent comment again. Allow me to come to the control discussion. I'll come back to that, inshallah. Excellent comment and excellent question. I'll answer it, inshallah. There is comment from Sister Malika bin Al-Kama. Salam, dear Professor. Wa alaikum assalam. I'm not a professor, but okay. If I look like one, then it's thanks to you. What is the difference between hybrid pooled Sukuk and variable rate redeemable Sukuk? This is a question that, again, if you allow me, we have a discussion on the hybrid one, then we'll come to that one, and we'll come, and for the tier one, we'll come to that. We'll answer at the right place. Thank you again. I'm keeping this question open, and I'll answer it, inshallah, at that point of time. There is another comment from Brother Irshad Ali Yaftali. We have no similar standard in Islamic finance in Islamic countries. At the same time, we found different standards in the process of Islamic finance overall. Same is Sukuk case. Please need your guidance by whom and where uniform Islamic financial process is taking place. Every Muslim should follow that. Brother Irshad, your question has raised one of the most important questions, and AOFI's sheer existence is an answer to that. The reason of having AOFI in existence was actually, and AOFI having 3 different boards and developing five different sets of standards. We have right now, I believe, 123 standards and pronouncements that are in effect today. Some of them will be replaced and some new are already there. So 123 we are talking about, and there are, I think, nearly 12 exposure drafts right now I think 13 or 14 exposure draft right now under discussion. So as we see towards the end of this year, we might be having 135 plus standards. Brother, our standards cover Sharia, accounting, governance, ethics, all these things are there. So the point is that Sharia provides some boundaries. Within those boundaries or within those hudud, we actually keep the options open within our standards. So there is no need that every Sukuk in the world will be exactly the same. But all Sukuk in the world should be following a same set of standards. This is very crucial, and that is where AOFI comes in. Alhamdulillah, our standards in one or another form, you can have access to our footprint report, which is available on our website. footprint report 2022 is available on our website, which you can have a look at. In nutshell, around 45 regulators or 47 regulators in around 32, 33 countries, they actually adopt AOFE standards fully, partially, as reference or as supplementary reporting. It is important that all of them should come together toward adoption of the same standard. Still, adoption of the same standard will not mean that every sukuk will be the same, but it will mean and ensure that all the sukuk are like all the sukuk or all the Islamic finance practices across the globe are taking place according to a set of principles. And we are trying to do our best, and you guys in your respective countries, in your respective jurisdictions, need to play the same role for supporting the activities of AOFE and adopting them in on a global basis, like in their full and true spirit and the full set of that. Thank you very much, Brother Ishaq. Okay, now there is a question, Brother Amin Dandia, my dear brother. It is very good to see you here. Assalamu alaikum, wa alaikum assalam. Is there any requirement for tangibility ratio in your standards? Brother Amin, tangibility ratio issue has been addressed more recently in detail a couple of years back by UFI in Belden standard. So there was a tangibility ratio earlier available with regard to only the screening of investment, but there is tangibility ratio issue now available for other type of assets also. But again, the new Belden standard has one significant restriction as compared to the earlier one, and the Sukuk standard that has been issued now as exposure draft also has this challenge that earlier people used to do a bundling for the sake of for namesake. Like, you have debt and you just say, oh, I just add, like, for example, I have debt of 1 million. And then I say, oh, I just attach this asset, which has no link with this one, but I attach it as a bundle. And I create the tangibility ratio. I meet the tangibility ratio requirements. The new standard says that that Belden standard and also the Sukuk standard exposure draft goes in the same direction. And the more recent accounting standards, even where we have addressed this issue, we have come up with the same part that we have said that the tangibility ratio will not be applicable. It will not be applicable like, how would I say, will not be applicable just for the namesake. It can be applied if you create an entity for that. So if the SPV has debt and assets, then this bundling will be acceptable. But bundling only for the sake of bundling without creating entities will not be acceptable. That, oh, I have just this asset and this asset, I just make a hypothetical sort of bundle. So now tangibility ratio requirement is updated in the new Sukuk, new Belden standard. Now, new Belden standard, what does it say? It says that the tangibility ratio must be 51%. Now, even that 51% application has market perception issues and disputes. Because, for example, as per Sharia standard, then has to be calculated based on the face value. So that applies as per UFI accounting standard also. So if you create a then, for example, if you bundle tawarruk with physical assets, so the then which is created include the profit receivable in future, because as per Sharia, it is not interest, it is just a sale transaction result and the net receivable is already there, which means that this 51% ratio is to be applied against that. So conceptually, AOFE has observed from the accounting, governance, Sharia, all sides, we have observed that the market has in the last 10 to 15 years has moved towards those type of hybrid structures. And here I answer one of the earlier questions as well, that those type of hybrid structures are prevailing, where actually it is a debt that is being created as a sukuk, and there is a bundle of assets being attached to make it tangible and make it tradable, rather than actually having the underlying assets being tangible. And in this situation, we have seen situations where the whole of the return is guaranteed actually by the profit element on tawarruk, rather than actually by the result of the underlying assets. And not only this, some of the observations are there that even this has become so, sorry to say, badly practiced, that it has taken the form of like, the full capital guarantee through Tawarruk transaction. Now, first thing, AOP Sharia Standard 30 on Tawarruk does not prefer Tawarruk as a common source of financing and funding. So we do not believe and we do not promote any Sukuk based on Tawarruk. Number two, if on the need basis, Tawarruk based Sukuk based on this bundling and all this are there, they have to fulfill the new requirements of the AOP Sharia standards, the then standard as well as the new exposure draft that is coming in, which will not be allowing you to guarantee the whole of the profit and whole of the even the tangible asset part by creating a profit on the Tawarruk side. This is something where we know that industry, sorry to say, is not happy with us. We have observed a lot of voices. Again, those of you who have valid comments on this part, more than welcome. But we believe, as per our Sharia Standard 30, Tawarruk is not a common form of financing. Tawarruk is on need basis. Secondly, using Tawarruk in a way that bundling of asset becomes just a namesake bundling, that is not acceptable. You need to create an entity, and that entity need to create a 51% ratio. Now, that 51% ratio can go down up to 33% for a limited period only. But if it goes less than 33%, then the trading of that Sukuk is not allowed. And within that period of 2 years, you need to come back to the original value. So this is like, brother, I mean, you have put a very small question, just about tangibility ratio in 2 lines, 1.5 line. But the answer, I know that I've tried to explain this thing in reasonable detail, but there are even more angles to that. Some part of it is going to address the accounting side as well. This standard was issued in December 2022 as exposure draft. When we finalize, we might need to make a couple of changes here. You might need to see at the tangibility requirements related issue that we addressed in the investment account standard as well, because and the transfer of asset standard as well, because even the internal transfer of asset between one pool to another pool will be subject to the new requirements as per AOP. So with that, I know that I have taken a lot of time on this issue, but I know that it is a concern for a majority of you. So again, if anybody want any further comment on this one, we just believe in one thing. At AOP, we are here to do the right thing. We need to do what is we need to interpret, and we need to provide guidance and principles based on what is the Sharia requirement with regard to these aspects. We believe that there have been some of the market practices which might be allowed by individual Sharia boards, etc., but might not be acceptable by a majority of the scholars. So as a standard setter, you need to always stick to something that can be accepted by majority. Let me put it, for example, there are 3 types of Sukuk in the market. One is based on Tawarruk, without any tangibility requirements of AOP being followed. The second type of Sukuk is where you have a proper Ijara Sukuk, where all the terms and conditions related to Ijara and everything are maintained. Okay. The third type is where you have a Mudarba or Musharaka based Sukuk, where all the relevant conditions are fulfilled. The point is that for me, as an investor, do you think that all of the same are the same? I know a lot of people who consider Tawarruk as completely haram, and particularly the organized Tawarruk has been considered impermissible by OIC Islamic Fiqh Academy. Similarly, AOP Sharia Standard number 30 put some strict conditions on the issuance of for the Tawarruk transactions, which, in my humble opinion, and brother, I mean, you may recall we had a discussion on this point some time back, that considering all of these Tawarruk transactions to be over-the-counter transactions on a pre-organized basis, they may not meet the requirements of AOP Sharia Standard at all. Which means that AOP Sharia standards do not endorse and approve a number of Sukuk or a number of tawarruk transactions that are already there in the market. Now, the question is, if somebody want to follow the Sharia board that approved that transaction, there is no harm for them. But can we make those sukuk generally available to everybody in the market, and everybody in that situation will have to every time go to the structure and see the detail? And do you think that common man or a common investor has the capability of doing this thing? This is where we need to address the issue with setting standards which are acceptable to the majority, the standards which are become a consensus. Whatever work is done by UFI Sharia board takes form of a consensus, ijma on some of the matters related to Islamic finance. And again, there can be individual views, even of the scholars sitting in the board itself. But when it comes out of the board as a Sharia standard, or when it comes as another standard by another UFI's board subject to review by the Sharia committee and all that, we believe that these are the consensus situations with regard to what is the true nature as per Sharia. And I can assure you that for us, we want to safeguard the interest of the stakeholders. But for us, the first and the foremost interest to be safeguarded is the interest of the Sharia compliance from all aspects, Sharia, governance, and accounting. Sorry, I took, again, with a short question, I took a lot of time. Thank you very much, Brother Amin, for being with us and for raising this question. We have question from Brother Muhammad Bilal Nabizada. Salam, sir. I would like to kindly ask that what adjustments are made to the balance sheet when sukuk mature or redeemed? Thank you very much. I'll come back to this one later, brother. This will be answered. But now I'm feeling very happy. Actually, I can see nearly 128, 130 people online and so many questions coming up. So I'm now getting afraid that whether I'll be able to complete the standard itself or not. Inshallah, we'll be able to manage time. So this one will come back later. We have Brother Sanaullah Ansari. Assalamu alaikum wa alaikum assalam, and thank you, brother, for being with us. Normally, sukuk are issued in international market which are conventional based. Then how sukuk can maintain an Islamic nature in these markets? Brother Sanaullah Ansari, you have raised a question. Let me mention a comment. That comment is by Dr. Sami Swellam. Some of you might know him already. Dr. Sami is one of the very well-known Islamic economists and scholars. Dr. Sami is acting Director General of the Islamic Development Bank Institute. He said he said something which touched my heart, and I want to repeat it every time. But I am repeating with his name because I acknowledge him as a mentor, as a person from whom we all learn. Dr. Sami said that you are trying to sell fruit juice in a market where alcohol is sold. Brother Ansari, you got my point? We are trying to sell sukuk to the investors of conventional bonds. Now, what happens that while we might need to sell it to them, that is correct, but the problem is then they want the characteristics of alcohol in your fruit juice. So you try to do, okay, now I do some engineering to my fruit juice so it looks like alcohol. You got my point? The problem is Islamic finance is a different animal. We are talking about a drink that is halal. We are talking about a drink that is permissible. That permissible drink, which is like a fruit juice or a pure water, if you take it and try to sell it in the market where the primary product is alcohol, what will people do? They will ask for the characteristics of alcohol in your pure product. That is where we are stuck. We go to the same lawyers who are conventional based. We go to the same rating agencies who do the rating as per conventional mindset. We go to the same markets and try to sell our product to the same investors who are conventionally minded. Then obviously at times you compromise. The rating agency and the legal advisors, when we talk to them, they say, oh, we are not against Sharia. But the problem is that we have to safeguard the interest of the investor. Now, they say our investor is agnostic. He's not concerned about halal or haram. He's concerned about return and security. So we need to give him return and security. And that's why that's why in most of the situations that we have seen, the final draft of the Sukuk document is not done by the scholars. It is done by the rating agencies and by the lawyers, which means that at times some of the Sharia principles are compromised. Based on my experience, I have seen it a lot. And as you said, Brother Ansari, this is something like, we need to start thinking of, because it is the commercial interest. What happens? Our commercial interest overrides the Sharia compliance. We need to start thinking on these grounds. And I can still assure you that if you change the market, you will find it. There is some example that at times I mentioned. Sorry, it's a bit like, we are getting off track, but it is a very good example we need to understand. I've made this example earlier as well. Maybe some of you might have heard this from me. We learned it from a management lesson that they said that a new CEO of Coke was appointed, and he was like, asked to, again, as the new CEO, every new CEO has the target for increasing the profitability and the market share. So he first asked for the reports for the market share. He got the reports based on Coke, Pepsi, others, for all the regions, all the markets, because these are the two big players, and then others. Coke, Pepsi, others. He said, no, I don't want this report. I want the report against Coke consumption, against overall human liquid intake. So I don't want you to give me only against Pepsi or others. I want you to give me against fruit juices, against water, against alcohol, against whatever people are taking as liquid intake. So the point is that if a person is thirsty, they must have this in front of you. So they started putting vending machines on the railway stations and bus stops and all the malls and everywhere. And they entered into some of the fruit juices markets and the water market. So now what happens? That the market share, they were not comparing against the competitor. They were comparing the market share against the total market need, because every single individual gets thirsty and he needs something to drink. And if you provide him what he needs to drink, this will serve the purpose. This is where we are stuck. We every time compare it with conventional, and we every time try to mimic conventional. I agree that this is the challenge that we have, that currently Islamic financial markets are not developed to that level, and the common man and the remaining others and all that are not interested in Islamic finances yet. But I can assure you that if you try to expand in the right direction, still there is huge room for expansion. Thank you very much. Brother Musa Zuma has raised a comment. Is it tangibility ratio or cash and cash equivalent ratio? No, brother, it is tangibility ratio or tangibility requirement. We don't call it cash and cash equivalent ratio, because receivables and other things might be there as well. And some of the things might be tangible exactly or not. So we are using the term tangibility ratio, but otherwise only cash and cash equivalent ratio might not be enough. It would be cash and debt ratio, maybe, if you want to name it differently, but we name it as tangibility ratio or as tangibility requirement. Thank you very much, Brother Musa, for being with us, and thank you very much being here. Brother Amin Dandia has a question again. If the Sukuk is based on Ijara asset 55% and 45% Tawarruk without linking it to the SPV, Brother Amin, as per the Tawarruk, as per the Beldain standard and our new requirements, you need to transfer both assets, that is Tawarruk also, to this one. Secondly, when you say Tawarruk 45%, brother, this is 45% Tawarruk principal or Tawarruk total receivable. Because from Sharia perspective, This is a discussion point that we had with the Sharia committee also, that, and they at least agreed also, it is not very clearly written in the standard, but they agreed that 45% principal will not serve the purpose, because 45% principal means that if you add for 5 years the profit on that, it may become 65 or 70% of the total. So from that perspective, it has to be 45% including profit and not excluding profit. So it should not be 45% principal. While for Ijara asset, the rental is earned in future. So that will be only the Ijara asset value and not the profit included. While for Tawarruk, it will be profit included, which means that if the ratio that you are mentioning, for me, from day one, this ratio is out. Because I've seen people putting 45% as principal. But if it will, I will be shocked if you say that no, 45% is the total receivable, because nobody cares for this. Thank you very much, brother Amin, for raising an excellent question again. Brother Muhammad Jidda Tom has a comment, and long comment. Let me read it. Okay. Okay, he has provided a detailed comment. Brother Jidda Tom, thank you very much for being here, and thank you very much for your kind comment. I'll try to just put it like, put it very quickly as a summary. So Brother Jidda Tom's comment is, he's not asking a question, rather he's just clarifying some of the points. So Brother Jidda Tom, you can put this in the chat window also for the benefit of the participants. They can have a look at it. I think you have rightly said it. In a nutshell, he said that AOFI only considers the Sharia compliant structures, and hybrid structure may include tawarruk, muraba, or other form of liability in addition to tangible underlying assets. So it should be according to Sharia Standard 17, that is current Sukuk standard, and Sharia Standard 59, sale of debt standard. Thank you very much, brother. Your comment is good. It's a detailed comment, so I would suggest, if you like, you can put it in the chat window for the benefit of other participants as well. We have comment from brother Najibullah Faizi. Assalamu alaikum wa alaikum assalam, brother. His comment is, sir, you have mentioned that tawarruk is not common form of Islamic finance if it's only need-based. If you, sir, describe which are the case, and also there is one point for no tangibility. First thing is, brother Najibullah, what I'm saying is the summary of the Sharia Standard 30, where it says that tawarruk is a transaction to be done on need basis only when other modes of Islamic finance are not available. In certain situations, it strictly prohibits, like, for example, for providing funding to conventional financial institutions, the standard says it should not be done. It says that it should not be done for raising deposits or getting, funding based on that. Or other transactions should be also on a need basis. At AOP Governance and Ethics Board, we are currently developing a very comprehensive standard on the controls that should be there on the tawarruk transaction. So from that perspective, inshallah, we'll be shortly, maybe in the next 3 to 4 months, we'll be coming up with the exposure draft, and a lot of further details in regard to that will be clarified, that one. Your second part of the question is not very clear to me, and there is also one point for no tangibility. In a nutshell, I would say that if there is no tangibility, the transaction is permissible, might be if the structure is okay, but the sukuk is not tradable. So for those of you who, I'm sorry, I should have clarified this thing very clearly, that it is quite possible that the structure of the sukuk is permissible, but that structure include debt primarily. And since Sharia does not allow sale of debt at value different than its own value, other than at a value other than the par value. So from that perspective, tangibility ratio or tangibility requirements are there to make the sukuk tradable or make the debt transferable. This is where if there is no tangibility, the sukuk may be permissible by structure for issuance of sukuk and redemption of sukuk with the same parties, but not for transfer of sukuk for other persons, which means that the purpose of this purpose will fail actually, because sukuk need to be transferable. And that is why the tangibility ratio becomes, or the tangibility requirements become important. Tawarruk, when we say no tangibility in tawarruk, means that we are saying that tawarruk represents a debt. It does not represent our asset. Since it represents a debt, so its transfer is not permissible at a value other than its total face value. Hence, it renders sort of like sukuk to be non-transferable. I think I explained this thing. I'm just repeating it for clarification purpose. Thank you very much, brother. Brother Amin, you are welcome. Okay, we have another comment from brother Sayyid Imtiaz Abbas Hussain. Are returns to sukuk holders on equity-based sukuk guaranteed, while in Islam no one can guarantee? Okay. Brother Sayyid Imtiaz Abbas Hussain, excellent comment, very excellent comment. We believe that as per Sharia, the same principal and profit cannot be guaranteed. Only the performance can be guaranteed, and in some situation there can be a third party guarantee. When we say performance can be guaranteed, means that against the willful neglect and against the performance of the responsibilities, neglect or breach of contract, these things can be guaranteed through other sources, and there can be third party guarantees in some situations. That's a very complicated issue which need a specific discussion more on the Sharia side and less on the accounting side. In accounting, we are just concerned that if there is a Sharia compliant guarantee, what happens to that? We have addressed this issue in this standard and also in the control standard. Thank you very much again, brother. But saying that in Islam there is no guarantee might not be correct. There are limited forms of guarantee which are covered in Sharia Standard 17, in the standard on guarantee, in the standard of the guarantee of the agent. There are multiple, if you're already addressing it. And then there is the new exposure draft of the Sharia standard on sukuk. We have comment from brother Irshad Ali Aftali. Another issue we are facing is that discount rate of interest of State Bank is also same acceptable for both conventional Islamic banking. What standard discount rate followed by Islamic banking sector? Is that a foundation center who provide mutually acceptable rate for Islamic banking to further apply the same on customer? Okay, so your question has two parts. Number one, can a conventional rate be applied on sukuk or other Islamic finance instruments? The answer is it is not preferred, but it is not haram to use a conventional rate. AUFI Sharia standard at multiple places have clarified this issue that although it is always better to have a specific rate for Islamic finance, but using a conventional rate in the transaction does not make Islamic finance as impermissible. So this is part one of your answer, and this is the current situation. Part two, what AOFI is doing on this part, because there is no foundation center or anybody, but AOFI is doing a huge project on this part. We have issued an exposure draft on Sharia on the governance of Sharia compliant benchmark rates. So the Sharia compliant benchmark rates governance standard has already been issued. We are developing some working models based on that, and inshallah we'll be coming up with the models shortly. On the exposure draft of the Sharia compliant benchmark rates governance standard, we have worked very extensively, and it has a very well respected set of scholars and experts who are part of that standard setting process. It will take some time because we wanted to put it on priority, but some priorities change. But shortly, inshallah, we'll be reverting back on this, and we'll be coming back on with the standard, inshallah, like the models and then the standard, inshallah. It's a very comprehensive project, and it's more than midway done, I would say. But in last 2 to 3 months, we have got we got very much occupied in some of the pressing engagements. So it is a bit delayed, but inshallah, shortly we'll be coming back to that. So with that, we are actually also talking to some of the regulators to be part of our initiative for that, to do the testing of the models that we select. Thank you very much, brother. Brother Sanusi Yahya has a question about Assalamu alaikum wa alaikum salam. Please explain the difference between quasi equity and liability. Brother, I'll explain it very shortly. Let me move ahead with the standard, and thank you very much for being here with us. Thank you very much. So now I think I need to move ahead. There are a couple of questions which are not finalized, okay, which are not responded. Okay. Just sorry, one more question from anonymous attendee. First thing is I always request the anonymous attendees to just put their names or the name of the institution as they like. You can always rename yourself. What about issuing sukuk on behalf of another party? Will this standard be applicable to the issuer? Keeping in mind that the issuer is only an intermediary between issuer and buyer. Brother or sister, because you are anonymous, so honestly, I don't know. In a nutshell, I would say that this applies not to the issuer but to the originator. Or issuer in this situation may even become the SPV, and that is why the first version of the standard used the name sukuk in the books of the issuer. But now the newest exposure draft says the sukuk in the books of the originator. And that was the reason that we wanted to avoid that confusion. So we are talking about, so for example, there is a bank A, there is a SPV B, okay, and there is the sukuk holder. So the SPV might be issuing sukuk. Like, for example, SPV may be incorporated in Cayman Island, and it might be issuing sukuk from there. So technically, the bank A is not the issuer, but it is the originator. That is why we have put it this for the accounting for the originator. Now, for the issuer, that will be subject to financial reporting for the sukuk holders. So they may do they need to do an accounting, a summarized accounting for the sukuk holders. That is our approach taken in this standard and FAS 34. And if you have any other question, please feel free. And also, if you can kindly name yourself. Thank you very much for being with us. This is comment from Brother Azizur Rahman. At the scenario of event of default in case of Wakala Sukuk having the underlying structure of Ijara and Mudarba with the tangibility ratio of 51:49, where the obligor has given the purchase undertaking to repurchase the Sukuk portfolio at the event of default. Please confirm if Sharia standard view whether it should be purchased by the obligor at market value or book value. Please also clarify about market practices. Is it Mufti Azizur Rahman from UAE or somebody else? I don't know, but anyway, welcome, brother, and thank you for raising a very good question, an excellent question. Now, the problem is that it's an excellent question, but it is taking me and dragging me away from the topic for today. Today's topic is accounting, not the Sharia. But in a nutshell, I would say that I'm afraid that tangibility ratio may not be there. Obligor is not the term accepted by OFI Sharia standard and OFI accounting standard and governance standard. We consider the originator as the right term. We don't believe they are obligor. There can be a purchase undertaking of the Sukuk portfolio, but we have in accounting. This is the question part that is related to accounting. As per Sharia, you better know than me that you cannot combine two contracts in one contract. So by not combining two contracts in one contract means that you need to keep them separate. Otherwise, it will become like impermissible. At times, I quote our respected Professor Munzir Qahaf. He said in one of the conferences, he said, and it stuck to my mind, and I quote him all the time, that he said that وَقَدْ نَهَى رَسُولُ اللَّهِ صَلَّى اللَّهُ عَلَيْهِ وَسَلَّمَ and بَيْعُ السَّلَفِ, that Nabi Karim sallallahu alaihi wasallam prohibited to combine the sale transaction with a loan transaction. And then he asked that, do you think that there was enough paper at that time that everybody can just write on two different pieces of paper? So this is a question that was stuck in my mind, and that is the question that I will raise to all of you, that do you think that just making two different papers would make it permissible? Or you need to keep it actually different? So what we believe is allowed by Sharia is that a purchase undertaking in the event of default does not, or at the maturity, even there are purchase undertakings at the maturity also, they do not constitute the main part of the transaction structure, but rather they are options or promises or undertakings separate from that, and they need to be accounted for separately. So if you are feeling a risk that there is an event of default approaching, In that situation, that undertaking or promise may become onerous, or an option, if there is a similar option there, that option may become onerous. So an onerous commitment as per AOP, this exposure draft, as well as FAS 30 of AOP, that is impairment credit losses and onerous commitments. According to these standards, you might need to book and with line with the Wad Khiyar and Tahawut standard that we have, you need to consider this portion separately from the primary structure. You cannot combine it in the same structure. Here, there is the difference between AOP and IFRS and other, conventional thought processes, that we believe that only making two different bunch of paper will not make it halal till the time you don't actually keep the transactions separate. So keeping the transaction separate means you cannot consider it as a combined transaction and the counterparty being an obligor. And that is why we insist that AOP Sharia standards are important, but accounting standards are equally important to be adopted. Because on one hand, if you follow the Sharia side and you don't follow the accounting side, what will happen that on one side you are saying, oh, we are complying with Sharia, but on the other hand, you are saying, oh, we are just making a bunch of paper to make fool of you. Because in substance, we are doing what the conventional is doing. This is where we have a huge arguments and we have huge discussion on this point. In a nutshell, this 51-49%, particularly based on the answer that I provided to my earlier brother Amin, that even 45-55, I'm afraid that might not be meeting the criteria as per AOP, because the tawarruk value as per Sharia will be including the future profit. The tangible asset value, either under wakala or under ijara or under musharka, mudarba, whatever form is, the tangibility would not be including the future profit. But tawarruk will be including the future profit, which means the ratio will be out again. I think we have very good discussion. To be honest, I'm enjoying it, but now I'm getting afraid. I'm afraid that I may not be able to complete the standard. Also, although it's not a very long standard, but it has so many complicated discussion issues that actually we need to move a bit faster. So what I will do now, I'll complete first scope section and definition section, and then we'll take comments on scope and definition, and then we'll move ahead. So all definitions I'll not be discussing, but some important ones, particularly where I have received questions from the participants, I'll explain them. This standard shall be applied for accounting and financial reporting for Sukuk in the books of the originator. The standard determines the requirements of primary accounting treatment, presentation, and disclosure for disclosure of Sukuk in the financial statements of the originator. This standard does not provide individual accounting treatment of each Sukuk type and structure based on either structure or the underlying product. Nevertheless, it provides principle-based accounting treatment for broadly two types of Sukuk issuances, that is off-balance sheet and on-balance sheet, as well as any subcategories as applicable. With the scope, I would suggest I will read this para with the scope in the end as well, because it is in the end. Amendments to other standards. This standard does not make amendment to any other AOP phases, but shall take precedence to other AOP phases with regard to the principles specifically described herein in respect of financial reporting for Sukuk and similar instrument. So the scope para and this para together are to be read, and I would suggest to our team for internal note that, sisters, if you can just make an internal note that we create a cross reference of this this paragraph 4 or 5, we create either 4 or 5, we create a reference to that amendment to other standards para to clarify that this one will take precedence. Detailed accounting and disclosure requirements for the Sukuk structure as well as the underlying product shall apply in accordance with the respective requirements of respective AOP phases for the time being in force. In case the Sukuk structure contains more than one product, each product should be accounted for in line with the respective AOP phase. This is another answer to Brother Azizur Rahman, that we do not allow in this situation both to be accounted for as a single product, as a liability. We require that wakala part is to be recorded as wakala and relevant accounting treatment to be followed, and tawarruk part to be following the tawarruk related requirements. So, or mudarba and ijara versus wakala, whatever it is. So considering more than one product does not mean that it become a single product because the example that I gave, that only making two different papers does not make it a single, like a Sharia compliant, unless you actually consider both of them separate. So from that perspective, both accounting for both structure product parts will be separate, and tangibility ratio issue, as I mentioned, will also be considered from that aspect. So these are the requirements as per AOFI Sharia standard and as per this standard. And again, at times you feel that some of the standards can bring drastic changes. That was my starting point. I can assure you, if somebody follows the new set of AOFI Sharia accounting and governance standard on Sukuk, I can guarantee that those Sukuk will be Sharia compliant. But unfortunately, we have seen the majority is already not following them. Now, some important definitions. Business is an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing a return in form of dividends, lower cost, or other economic benefits directly to investors or other owners, members, or participants. Owners, sister Saira, here there is apostrophe after owners, which need to be removed. Okay, maybe a find and replace issue. Please make a note of it. Liability is a present economic obligation, legal or constructive. So there was a question by our participant. So let me clarify liability and quasi-equity. Liability is a present economic obligation, legal or constructive, other than quasi-equity, that is enforceable against the institution, resulting in an outflow of economic resources. A liability results from a past transaction, other event or condition. A future commitment is not considered a present obligation for the purpose of this definition unless it is considered onerous. Now, this is the definition of liability. I believe this is exactly as per our framework. Quasi-equity, let me read and then I'll come back to this. So let me read first quasi-equity. Quasi-equity is an element of the financial statement that represent participatory contribution received by an institution on a profit sharing or a participation basis. It has primary characteristics of equity, that is, in case of loss, unless negligence, misconduct, breach of contractual terms is proved, the institution is not liable to return the funds to the fund providers, and the fund providers share the residual interest in the underlying assets of business. And certain characteristics of a liability, that is, it has a maturity or a put option of redemption or liquidation, and certain specific features, that is, the right of the fund providers, are limited only to the underlying assets or business and not on the whole of the institution, as well as they do not have certain rights associated only with the owner's equity. Okay, so now let me try to explain. IFRS does not have the concept of quasi-equity. And again, I don't want to criticize on anybody, but let's go back again to the question by Brother Azidur Rahman. So now the question was that there are two structures in one. And considering obligor, what all the Islamic financial institutions are doing today, they are just recording, other than those who are following AOFI, and even the countries where they are following AOFI, the problem is this standard is not yet final. So it's still some of them following IFRS. Now, what is happening that as obligor, they record a single liability. The question is, what are the characteristics? Does those characteristics meet the quasi-equity also? Are the Sukuk holder having a residual interest in the underlying assets? If there is residual interest in the underlying asset, this is equity. This is the primary definition of equity as per AOFI and as per IFRS. IFRS has a condition. They say that anything that has a put option. What is a put option or option? That is option of redemption in the hand of the investor. So if I am opening an account with the Islamic bank, I may be sharing with profits and losses, but if I have a put option, which means that I can go to the counter of the bank and tell them that please give me back my money today. So even if they are required to pay back the money according to profits earned till today, still considering a put option, they consider it a liability. Although it has a equity element built in, because the profit and losses actually emanated from the underlying assets are the ones that are to be paid to me. One of our accounting board members, actually a senior member, deputy chairman of the board, at times he laughs at a joke. He says that at times we combine two contracts and say, okay, it is one single contract. And this is very common for Islamic finance, that all our accountants from the conventional mindset and some of the regulators insist on considering it as a one contract. While on the IFRS, there is a concept of embedded derivatives. At times they say, no, you need to segregate the elements. From some transaction, you need to segregate the service element and the trade element. From some transactions, you need to segregate the credit element and the sale element. So at times you say that you need to segregate out of the same structure, while here there is a structure where there are 3 different documents and you say, no, combine them all together. I don't know. The problem is here that majority of our people think Islamic finance is a fake thing. They believe that Islamic finance is no different from conventional, and that's why they say we completely disregard the papers. Because I can tell you, IFRS does not require you to completely disregard the papers. It requires you to reflect the true information for the information needs of the stakeholders. So if you can insist that as Islamic finance, we are doing these genuine transactions, even under IFRS, we can find solutions which are Sharia compliant. But on one side, we say that, oh, all these are combined, so we put them all together. And on some time we say, no, we segregate this element from this element. In a nutshell, what we want to say is that AOFI and IFRS have one major difference with regard to the classification, that is the liability versus quasi-equity. There are certain instruments which have primary characteristics of equity, but have a put option. From AOFI perspective, they become quasi-equity, while from IFRS perspective, they became liability. So the Sukuk and even the term obligor and all that, coming from the same mindset that even if you issue Sukuk, you are obligor, you are just taking a liability. So anyway, we are trying to fight our battle here. We are trying to do what the right thing is, and we have to do the right thing. Sister Saira and Sister Hora, can you remind me when we need to take the break, because it's prayer time in Bahrain? So are we supposed to take break now, or we are supposed to take break at maybe 12 or what time? What I would suggest that let me complete the definition section and then we take a break, because it's a long public hearing session. People need to stretch their legs and we need to pray as well in between. So if you, I'll complete the definition part and then we'll come to that. So I think I have answered one of the questions that was there related to the difference between the quasi-equity and liability. It was from Brother Sanusi Yahya. Brother Sanusi Yahya, I believe your question is responded well. If you still have a question, then we can take it. Okay, now coming to no, I think other questions will come in due course. There are a couple of questions that I haven't answered, but they will come in due course. So now coming back to the definitions, liability, we discussed originator. Originator also referred to as the principal issuer. We use the term principal issuer only for reference purpose, but the standard uses the term originator. For the purpose of the standard is an IFI or other institution that issues the Sukuk in line with Sharia principles and rules directly or through the use of a special purpose vehicle or similar mechanism. Owner's equity is the residual interest in the assets of the institution after deducting all the liabilities and quasi-equity. This definition is close to IFRS, except for IFRS doesn't mention the quasi-equity part. Participatory structure is the type of contractual arrangement under which the parties to the contract share the profits, losses, and the residual interest in the net assets of the underlying asset of business. Sister Saira, just a comment for internal purposes. We need to align this definition of participatory structure with the final one that we have finalized with the control standard and the investment accounts standard. So just please make a note for the internal purposes. A special purpose vehicle, also referred to as a special purpose entity, is a legal entity. This S has to be small here. Sister Saira, the S of the also referred to as special, this S has to be small. A special purpose entity is a legal entity, corporate entity, trust or limited partnership, etc. After partnership, comma before etc. please. Created to fulfill narrow, specific or temporary financial objectives. An SPV in the context of Sukuk is not a pass-through entity and rather is an entity in itself meeting the definition of a business, usually managing the virtual Sukuk entity. Now here we come to a very important point, and it partially addresses one of the questions that was raised earlier. Conventionally, SPV is considered pass-through. Conventionally, SPV is by default a pass-through entity. It is not considered to be a separate entity. Our issue is that if we want to apply the Islamic finance transaction structures in the proper form, we need to consider SPV as a separate entity. We need to consider that actually the ownership and everything is transferred, etc., etc. We believe that SPV meets the definition of business. We believe that SPV need to prepare the financial statement for the virtual Sukuk entity or the Sukuk entity, depending on the type of reporting that applies and type of the instrument that is there. So this is something where we become different from IFRS. We are saying that again, based on the same thing that, okay, SPV was made for the sake of making SPV. There is no impact of that. It is just passed through entity. Here comes the issue of control also. The issue of control we will be discussing later, but the issue is that if you control the SPV, do you consolidate it? I think we strictly prohibit it. We say that if something needs to be kept off balance sheet, you cannot put it in the consolidation on balance sheet again, only because you say that, oh, we control the SPV. No, you do not control the SPV, rather you hold the assets on other people's behalf. Controlling definition, the definition of control and the issue of control has been addressed in this issue in this standard in detail. And now more recently, we have issued the control standard as well. And maybe when we finalize this standard, we might be deleting some of the sections related to control and will be creating a cross-reference to the new finalized control standard. So Sister Saira and Sister Hora, please make a note of it that some of the discussions related to control that are already covered in the final standard on control will not be repeated in this standard, but will be cross-referred to the final control standard. Now, coming to this point, that if I do not control something at the first place on standalone financials, do I control it for the consolidation purposes? We believe that in most situations, it will not be the case. And the reason of not being the case is because the control factors that you test according to AOFI will still not be meeting. Because if you are having control on behalf of others, or if you are having the governance or power, but the power is not for your variable benefits. And the variable returns or variable benefit that you are having must have the risk of loss. And since the asset underlying interest is residual interest of the underlying asset is with the investor, then if the Sukuk is off balance sheet, then even in the time of consolidation, that variable return element will not come to you. So this answers one of the questions that was raised earlier. Again, we have discussed this thing in the body text as well, but since we were discussing the definitions, so I partially answered the question that was raised earlier with regard to the consolidation part, that if something is on balance sheet, okay, something is off balance sheet for the basic accounting, would it become on balance sheet for the purpose of consolidation? That is one. The second question was from a similar question was from Brother Zafruddin Salahuddinov. I think it is Salahuddinov. I think the real name might be. Please apologize. You know, so many people from across the globe join in that at times I may not spell their names or pronounce their names very correctly. My apologies to all of you if I have mispronounced your name or misspelled your names. So my apologies for that. So now the question is second set of financials. For me, the second set of financials will be, one of them will be correct and one of them will not be correct. But again, if you are following AOFI standards, nobody can say that you don't develop a standard according to another set of reporting that applies in your country or IFRS, if it is like, you know, acceptable in your country. But what we believe is that AOFI standards provide the true reflection of the nature of the transaction structure, the business model of the institution, and the type of the transaction and the risk profile of that. Thank you very much, brother. Brother Sanusi, you are welcome. We have comment from the Komar Khalif. Does it refer to the originator Surah Fatir? No, I think the originator is the term as defined here. So it is not for the originator or the creator. So not related to that. But I think when we say originator, this will be read in the conjunction with the definition exactly as we have mentioned here. Okay, so Sukuk are certificates of equal value, sister. Just one thing, that since the final Sharia standard has been issued, so we might need to map the definition again. Although this definition is as per our earlier standard, so we might stick to it, but we will map it with the Sharia standard, and maybe we need to see if it needs to be improved. Sukuk are certificate of equal value representing undivided share in the ownership of tangible assets, usufruct or services in the ownership or in the ownership of the assets of particular projects or special investment activity. Such a special investment activity is referred to as a business in the standard. Sukuk may be tradable or not tradable according to the nature of governing contract or arrangement, as well as the nature of underlying assets of business. And Sukuk holders for the specific purpose of this standard are the investors being owner of the underlying assets of business for a Sukuk issuance by virtue of owning the Sukuk certificates. So these are the definitions, and I think I have, as I mentioned, that some questions are there which will be answered in due course. It is 11:50 now. It is prayer time in Bahrain, and I think it's a long public hearing session already. So we might need to take a 15 to 20 minutes break. What I suggest, I think 20 minutes break would be good to stretch your legs, grab a cup of coffee or tea, and to pray in those countries where the prayer time is already there. So we take a break here, 11:50 to 12:10 Bahrain time, inshallah. So we are keeping connected, and inshallah we'll be joining back at 12:10. Thank you very much. Assalamu alaikum. Assalamu alaikum, everybody. Sisters, what do you think we shall start? It's 12:10, 12:11. I think we still have majority of participants are there. We can see that obviously some participants left. It's a long public hearing and maybe some have got away for the break for prayers, etc. But I think it's 103 participants now. We can still continue. So, Bismillahirrahmanirrahim. Welcome back, everybody. And we are back with the discussion on the Financial Accounting Standard 29 exposure draft. This is like, we have nearly 50 minutes of the allocated time, and we'll try to keep it limited to that because it's already a long public hearing, a 3 hours public hearing. I can see couple some hands raised. I think one hand is raised. So Brother Ismail Ali Haley, I think we'll see towards the end if we can allow the participants to speak as well if the time permits. But as of now, I think we are not in a very good shape. We have to still go through a significant part of the standard. So maybe we'll have to wait a bit to see if we can take people on screen and with mics open. So please allow me a little bit time to see the situation. And in between, I've noted some of the questions, as I mentioned, were already there that I'll be addressing in due course. And if you have any other questions, please feel free to put them in the Q&A tab. Now moving to the body text, the requirements part, that is the classification and then recognition and measurement part. So first thing, the most important thing of this standard is that the standard is saying that not all sukuk are on balance sheet. Considering the nature of the transaction, considering the nature of the underlying structure, the asset may be off balance sheet. Now, this is now one change is there. I'll come to principles are the same, but one change is there as compared to FAS 29 earlier issued as exposure draft. That earlier Ijara standard of UFI, that is FAS 8, was not allowing the Ijara asset to be on balance sheet for the lessee, but now not the Ijara asset, but a right of use asset is allowed as per FAS 32. So this is one place where we have made an alignment with the old standard with the new one. So from that perspective, we have raised this thing, changed this thing slightly. So now let's come first to the principles. The broad classification. An institution issuing sukuk shall determine the extent of control of the institution over the asset or business underlying the sukuk instrument, depending on the structure entailing contract, product governing the relationship of the sukuk holder, the SPV, and the institution. So there are multiple factors. The first most important part is that first you need to determine control. And then second thing is that you need to see the structure, the entailing contract, and the product governing the relationship of the sukuk holder, the SPV, and the institution. If the institution concludes that it controls the underlying asset or business, it shall account for the sukuk issuance on a non-balance sheet basis as detailed in paragraph 13 to 32. Or B, it does not control the underlying asset or business, it shall account for the sukuk issuance on an off-balance sheet basis as detailed in paragraph 33 to 42. Now, this is where a significant change may be brought in for some of the institutions. The structure of Islamic finance transactions, independent contractual or promissory arrangement associated with sukuk issuance. This is addressing some of the questions raised, and it addresses some of the significant issues. The structure of the Islamic finance transactions, including sukuk having different underlying transaction, may include certain independent additional contracts, for example, a guarantee or agency or promissory promissory, for example, a purchase sale undertaking arrangement, subject to relevant Sharia principles and rules. There is a rebuttable presumption that the nature of Islamic finance transactions from Sharia perspective in most cases would not accept these additional contractual or promissory arrangement as a part of the core contract. So what we are seeing here is that most of the situation, there will be separate instruments of like promise or undertaking, but not a part of the core contract in most cases. Accordingly, these arrangements are considered to be independent contracts or contractual arrangements, including promises which by virtue of institution's goodwill or customary practice may be deemed as constructive obligation. So a promise can become a constructive obligation, but it is not a liability. So from accounting perspective, it can be constructed on a constructive obligation, and particularly if it turns onerous, you might need to do some accounting for that. Unless being part of the core contract, any guarantee or purchase sale undertaking or similar arrangement shall not be considered part of the core contract for the purpose of determination of initial classification that is on or off balance sheet, and instead all such arrangements shall be treated and disclosed separately as commitments. Now, guarantee sale purchase undertaking are not part of the core contract. As we said, normally in 9, they will normally not be part of the core contract. So hence they will be kept separate and accounted for separately. An institution on a periodic basis shall evaluate its obligations with regard to the commitments specified in paragraph 11. If it is established at any point of time that such arrangement is onerous in nature, the same shall be accounted for in line with the requirements of relevant FAS, that is particularly FAS 30, impairment credit losses and onerous commitments. Now, what is the situation where you can say that it is like, onerous? What will happen? So, for example, I have a promise that I have a promise to purchase the underlying asset of the Sukuk at a value equal to face value of the Sukuk. Now, for example, it is $100 million. Now, what happens that at any point of time, the fair value of the assets, or the expected fair value of the assets at the time of maturity, goes down that $100 million. It means that as a matter of promise, I need to still honor my commitment because it is a customary practice, and it's again some of the promises may be legally binding as well, particularly when they have a counterparty taking action based on that. So according to official standards, if a promise is legally binding by text or by virtue of other party taking action on that, then that promise becomes binding. And considering that binding part, what happens that this you cannot back out from that, and now it turns out onerous, which means that once it will be executed on a future date, it will give you a loss on that point of time. So that is the onerous situation, which here we are similar with IFRS, that onerous contracts as per IFRS also, even if they are relating to future, but they need to be recorded as liability. So if that undertaking element or the option element or the promise element, whatever it is, if it puts you in a situation that exercise of it will be giving you a loss on a future date, then you need to create a provision for that. This is what is required in FAS 30. Impairment credit losses and onerous commitments, and FAS 38 Wad Khiyar and Tahavut, and you need to refer to the respective standards based on that. Both of the standards have the same treatment. So this is what we need to do. Still, again, I come to the comment by Dr. Brother Azizur Rahman and others, where I mentioned it clearly that it will not be changing the main contract. It will not be making you obligor for the core contract. Rather, it will be creating a separate obligation against this promise, which will be recorded separately from the core contract. Okay, about the definition, there is a comment from Brother Najibullah Faizi. It's just a question: is SPV and SPE have any difference, or are the same if the same word used to both in this standard? We have used SPV only, not SPE. We simply said that in some of the markets it's called as SPE, or specific purpose entity. So that is just we clarified. Otherwise, we have used the term SPV only. Thank you very much, Brother Najibullah. So now we move to the next section. So from this is the determination part of control. Further details on this part are included in very comprehensive control standard, and there is a table particularly in the control standard. I would suggest everybody to see that table 1 in control standard that helps you understanding how control is established. Now, coming to on-balance sheet sukuk. On-balance sheet sukuk are those that do not meet the criteria for off-balance sheet sukuk. So by default, sukuk are on-balance sheet. It's not that by default they are off-balance sheet. So we are saying that if you meet the criteria of off-balance sheet, then it is off-balance sheet. Otherwise, all other sukuk comes on-balance sheet. So on-balance sheet sukuk are those that do not meet the criteria for off-balance sheet sukuk provided in paragraph 35, whereby the institution has control over the underlying asset or business. Such sukuk shall be recorded in the books of the institution. Brother Harun and Sister Saira, if we can just make a note of it, we might need to just clarify this thing a bit better. That's it. It's perfectly all right, but I think wording might need some improvement to make it more clarificatory. Such sukuk shall be recorded in the books of the institution and classified and accounted for in line with the requirements of paragraph 14 to 33. So we are saying that if you don't meet the criteria of off-balance sheet is where you don't control, on-balance sheet is where you control. Okay, and for this this standard does not have that detail, the whole table and everything, but as I mentioned, the control standard, which is recently finalized in December 2023, has all further details with regards to this issue. Some of the issues are here already in this standard in the basis of conclusion as well. Now, if you have on-balance sheet, what do? There are three classifications for on-balance sheet that we have. It can be an equity type sukuk, it can be a quasi-equity type sukuk, or it can be a liability side sukuk. Sukuk eligible for on-balance sheet accounting shall be classified and presented according to the structure, entailing contract or product governing the relationship of the sukuk holder, the SPV, and the institution, as well as the nature of underlying assets of business as either equity, quasi-equity, or liability. What are the factors to be considered? Are the structure, entailing contract and product, the relationship between the sukuk holder, SPV, and institution, and the nature of underlying asset or business. So all these things are to be considered together to determine the classification of those instruments. Sukuk classified as equity. Sukuk issuance shall be classified and accounted for as equity in the books of the originator if and only if the following conditions are met. Instrument is participatory in nature, that is, risk and reward of the underlying asset or business are shared by the sukuk holder. Instrument is either perpetual, that is, with no option of liquidation by the sukuk holders, or convertible to ordinary share capital of the issuer at its discretion, that is, at the discretion of the issuer, instead of liquidating the instrument, or a combination of both. Now, what does it mean? That the holder of the instrument does not have the put option. Why we were classifying quasi-equity separate from equity? Because there is a put option. Here we are saying that the put option is not in the hand of the sukuk holder, which means that if the sukuk holder does not have the put option, it means he cannot just go to the bank and say, or the institution originator to say, oh, give me my money. No, he has no option. There is no identified redemption date. There is no identified put option. Considering all of it, he will have to depend on what is the decision of the issuer with regard to the continuity or convertibility, etc. And from that perspective, since this money is always available, so even from accounting perspective, and here even IFRS IAS 32 particularly, and IFRS 9, if you read it with IAS 32, they are also considering it as an equity instrument, because even if it may have a different formula of profit sharing, but it will be subject to the risk and reward of the underlying asset, that is the residual interest in the underlying asset. And considering that, it becomes out of, from UFI perspective, it gets out from the quasi-equity and it goes to the equity. Sister Saira, here it reminds me of one comment, and let me note this comment. You remember that we were discussing in the investment account standard in the board, and there was a clause referring to the quasi-equity related treatment of this. And then it was decided that FAS 29 is the right place where we need to insert that. So just don't forget it, that we need to clarify this part, that while these instruments may be, I'm just mentioning the conclusion of the board to you, all of you, that the board concluded that at the time that equity related clause is not interfered, not invoked, till that time the accounting for this will be similar to quasi-equity, but as soon as the redemption or perpetuity clauses are invoked, then it will be converted as to equity. So the accounting part, because the profit sharing element part and some other parts of profit sharing, etc., might be similar to quasi-equity. So these instruments might still be subject to some of the quasi-equity related requirements. The standard on quasi-equity and investment account actually covers that part. Only thing is that here we need to create a reference on that. Instrument is subordinate to all liabilities and or quasi-equity instruments of the institution, during having absorption of losses condition. So these are the three main conditions that are to be there, and it is with condition with and. That is, all these conditions are to be met. Sister Sarah, just make a note of it on paragraph 15A. We need to see that we have seen that some hybrid instruments are also being issued as equity instrument, tier 1 instrument. So if there is a hybrid instrument which is issued as tier 1, which meets the definition of liability for us because of the majority factor, so that factor we need to address, and either in the standard or in the basis of conclusion we need to resolve that issue for condition 15A. Others are perfect. Sukuk, continuing. Certain wakala sukuk that do not meet the criteria of off-balance sheet sukuk may be classified as equity if they meet the above criteria. So while wakala sukuk are considered to be mainly off-balance sheet, but there can be situation that they are not off-balance sheet, and if they have this perpetuity or redemption condition, they may also be considered as a equity sukuk. Accounting for the respective instrument shall be made in line with hierarchy specified in paragraph 165 of FAS 1. That is, I think we should provide simply that the same accounting standard or a similar accounting standard sector need to be applied. That is the hierarchy. Cost of issuance, profit distribution, and movement in reserve related to such sukuk and FANI shall also be routed through the respective class of equity. Now, this was accounting treatment of the equity sukuk. Do we have any comments? I think, Brother Najibullah Faizi, I missed the session of about tradable and non-tradable sukuk. If you said clarify some areas of tradable and non-tradable sukuk, there, thank you. Brother Najibullah, if we can manage time, I'll come back to this topic again. Brother Muhammad Habibur Rahman has raised a question. What type of sukuk should be quasi-equity? I'm just coming to that. So I just reached that place. So inshallah, I'll be answering you now. Brother Misbahullah Fatah, okay, it is only Assalamu alaikum assalam, brother, but I can't see like your question. Okay, so any other question that we need to answer now? Okay, there is another question from Sheikh Muhammad Isa that I have to answer later, that I'll have to answer. Now about the classification part also, there is one question that I need to answer. Okay, so now coming to sukuk issuance that meet the definition of quasi-equity under this standard and do not meet the criteria of classification as equity as defined in paragraph 15 shall be classified and accounted for as quasi-equity. Such sukuk shall have the following characteristic. The fund or capital arising from issuance are made available to the institution in cash or in kind form of asset or business on participatory, that is profit and loss sharing basis. I think I think Sister Saira, I think we need to make it on the basis of participatory structure because we defined participatory structure now clearly. So just for the sake of alignment with the other standard, we just need to keep in mind just for the terminology, and that we need to maybe align with the other standard that we already finalized and the structure that we defined here. So instead of participatory basis, we should say based on a participatory structure. The institution exercises control over underlying asset or business, including management decisions, even if for the benefit of the stakeholders other than the holders of the owner's equity. So the control is there, and the controls underlying benefit is there. And I think we might need to create a reference to the table in the control standard here. The investment is not guaranteed, that is, unless loss is incurred due to negligence or violation of the contractual term, the institution is not obliged to return the funds it has received. And the sukuk holders, fund providers, on the other hand, do not have the common rights associated with the owner's equity. So we have these conditions for sukuk to be classified as quasi-equity. In most circumstances, on-balance sheet sukuk structures based on musharaka and mudarba would qualify to be classified as quasi-equity if they are redeemable by sukuk holders and or there is another form of put option, and if they do not meet the criteria for classification as equity. Certain wakala and restricted mudarba sukuk that do not meet the criteria for balance sheet accounting may be classified as on-balance sheet quasi-equity sukuk if they meet the above criteria. Similar to other forms of quasi-equity, for example, equity for restricted investment account holders, these shall be reported in the statement of financial position separately from equity and liabilities of the institution. Accounting for the respective instrument shall be done in line with the hierarchy defined in paragraph 165 of FAS 1. Now, what happens This is the reporting part. But what happens on the underlying? Initial recognition of the asset, initial recognition of the quasi-equity, the subsequent measurement of quasi-equity, subsequent measurement of subsequent measurement of equity, underlying asset of the quasi-equity, and then how the profit and loss will be determined and accounted for, all these things, and the pool accounting. All these are to be done in line with the respective standard. I think it will be important that we create a more clear reference to the new quasi-equity standard. It is understood. It is clearly saying as per 165, but I think before that we should say that shall be done in line with the new quasi-equity standard and read with the paragraph 165 of FAS 1. Then Sukuk classified as liability. Sukuk issuance shall be classified as a financial liability which is structured in a manner whereby the results of the creation of a present monetary obligation on the originator. On the contrary, for Sukuk issuance shall be classified as a non-financial liability if these result in an obligation to deliver goods or services. So if you have a Sukuk based on Salam or Istasna in which you are obliged to deliver an asset on a given date, this is a non-monetary, non-financial liability sukuk or a non-monetary liability sukuk. While if you create a sukuk whereby you have a murabha transaction or tawarruk transaction or any other form of liability that is being created, a financial liability that is being created in a manner that it puts a present monetary obligation, that today you have a monetary obligation, even if it is to be paid on a future date, but it exists a present monetary obligation. In that situation, it will be a liability sukuk. So sukuk structures based on murabha and other deferred payment sales and services, as well as ijara based on right of use asset, whereby the goods, services, or usufruct are required by the institution, resulting in a financial liability payable to the sukuk holder in lump sum or in a series of transactions over the period of sukuk, would generally fall in this category. An ijara sukuk, depending on the structure, would generally be a sukuk classified as liability for the originator and a sukuk representing a tangible asset in the hand of the sukuk holders. So this is something important, that according to the new FAS 32, you need to see that sukuk the originator will be having the usufruct of the ijara asset. So the usufruct of the ijara asset will be accounted for as an asset, but not as a tangible asset. But it will be recorded as an asset in the books of the originator, being the lessee in this transaction. So he will be having the usufruct asset and not the physical asset. The physical asset is supposed to be owned by the sukuk holders in line with the requirement of FAS 32. Sukuk structures based on salam, istasna, or service ijara shall be classified as a non-financial liability because these create a present obligation on the institution to deliver goods or services. However, during different stages of the transaction, depending on the nature of the contract and overall management, the amount received as advance may be presented as a financial liability. For some point of time, it might be a liability on a financial basis, but later going on, it will become a sukuk liability. Sister Sarah, the issue of hybrid, we have addressed the issue of hybrid at another place. I believe we addressed the issue of hybrid in the governance standard, where the governance standard or some other places, or maybe based on conclusion of the equity standard, quasi-equity standard as well. So the hybrid structure issue we need to address in this one, I believe, before we finalize, because we have raised multiple questions related to the hybrid structure. So the question will come with regard to the hybrid part. Although this standard says that hybrid structure will be recognized, like, both of the ends will be recognized separately. This part we are clear that hybrid structure, if it includes tawarruk and it includes ijara, both of these will be recorded separate, according to the nature of the contract, that we have clarified in the standard already. But I think with regard to the disclosure part, there are some element that we have covered in the governance standard. We might need to governance standard on sukuk and on Sharia compliance and fiduciary rating of sukuk and similar and Islamic finance instruments. So I think we need to consider that bringing something here in the explanation or in the footnote or in the basis of conclusion, considering the number of questions that we received on this aspect. Initial recognition of assets and liabilities. Now, I think there is one more question. Brother Fahmi Siddiqui has a question. We need one more point to be clarified from you. Is it in compliance with Sharia to mention in the underlying documents that maturity sukuk will be redeemed at par? Brother Fahmi Siddiqui, the answer is that we cannot simply say this thing the way you have said. There can be a purchase undertaking, and there are different principles as per Sharia for the purchase undertakings. So, for example, the purchase undertaking for a participatory contract like Mudarba or Musharaka, as per Sharia, normally it cannot be based on par, or even for Wakala bil Istismar. Normally, it cannot be based on par because it tantamount to guarantee of principal, which is not allowed by Sharia. So, guarantee of it becomes guarantee of capital, so it is not allowed. But if there is a ijara sukuk where there is a promise that ijara assets will be purchased at the par, or there is a diminishing musharaka, that is gradual transfer ijara product, in that situation, there can be periodic redemptions or a end of the period redemption in line with what is allowed by UFI Sharia standard in case of Ijara Muntahiya bit Tamlik and its different types. Considering these things in a nutshell, guaranteeing the capital in a participatory products is not allowed by UFI Sharia standards. Guaranteeing the giving a purchase undertaking for the underlying assets at the par value for the assets which are under a different contract other than participatory contract like Ijara, that is allowed by Sharia. Now, I'm just answering you a nutshell about this thing. Again, there might be more details about this issue that need to be addressed, and that will be addressed according to the respective product. So for every different product, there will be a different structure, a different condition might be there with regard to this redemption clause. Thank you very much, Brother Fahmi Siddiqui, for your question. Okay, now coming to initial recognition of assets and liabilities on account of Sukuk issuance, unless contrary to a specific requirement of the standard, the resulting assets and liabilities arising from the execution of the contract or contracts for the Sukuk issuance shall be initially recognized according to the nature of the contracts in line with the requirements of respective FAS applicable to such transactions. Carrying value adjustments. If an institution issues Sukuk instruments eligible for on-balance sheet accounting except for a sale and ijara back transaction resulting in transfer of risk and reward of its existing asset to the Sukuk holders at a value different from the carrying value at the date of transaction, the carrying value of such asset shall be adjusted in the books of the institution, and any resulting gain or loss related to participatory stakeholders other than owner's equity shall be immediately recognized. Related to owner's equity shall be accounted for in the following manner. Let me first explain, before going to this all detail. So, for example, I'm issuing a Mudarba Sukuk. I have assets of $100 million. I issued the Sukuk, but at the time of Sukuk issuance, we did a valuation of those assets, and valuation comes out to $150 million. So now I'm doing Sukuk of $150 million. So we are saying that the carrying value will need to be adjusted because it's on balance sheet, but still its value is being changed. So it needs to be adjusted. Now, how it will be adjusted? That value related to participatory stakeholders other than owner's equity. So for right now, these assets are owned by, for example, the investment account holder. So the investment account holder related portion shall be immediately recognized as a gain, and that gain need to be passed on to them. Even if there is a loss situation that instead of 100 million, it comes to 80 million, and we issue Sukuk based on 80 million, then this $20 million loss need to be passed on to the investment account holders. Now, coming to the other part, like proportionate ownership of the owner's equity. So if there is a gain or loss arising in the items of current nature, they shall be recognized as a gain of loss arising on the item of current nature shall be recognized as an income or charge for the current period. So there was inventory, like these were kept in the current nature assets, like asset held for disposal or something, or they were purchased as inventory, but later decided to be converted into a long-term asset in form of Sukuk. So in situation of assets being on current nature, this shall be recognized as income or charge for the current period immediately. A loss arising on the asset of long-term nature shall be recognized as a charge for the current period to the extent of any impairment. So if there is a long-term asset, like there is plant and equipment, and that plant and equipment has a loss situation, but that loss situation is not because of impairment, but because of the margin of transaction. So what happens that at times the fair value, the asset value is 100, the fair value is more or less 100, but the force sale value comes to 80. Now, 80 million is the force sale value. So Sukuk structure mostly will be based on 80 so that it gives a margin for the Sukuk investors. Now, based on that force sale value, this force sale value might not be an impairment because the asset may still have, because according to AOC and according to IFRS, an asset that is in your use need to be assessed based on fair value as well as value in use. So if your value in use is higher than that, then it means it is not an impairment. Or even if the fair value does not necessarily mean the force sale value, because the force sale value might not be exactly the fair value. It might be with a margin of a loss for the margin, with the margin for the benefit of the investment account Sukuk holders. Now, what happens that in this situation, this loss, if this loss represents impairment, it should be immediately recognized. If it partially reflects impairment, it should be immediately recognized. A gain or loss over and above the amount of an impairment identified arising on assets of long-term nature shall be recognized directly in equity and shall be amortized over the shorter of the period of respective Sukuk transaction or the useful life of the asset. So any other additional loss which is there that you are recording, which is not in the nature of impairment, it will not be impacting your carrying value of the asset. Rather, it will be impacting, it will be created as a reserve or negative reserve, and it will be amortized over a period of time. Now, this condition, we said that it is except for a sale and ijara back transaction, because sale and ijara back transaction will be subject to accounting under the IS FAS 32. I think when we say Sister Saira, when we say accounted for in line with respective OFI FAS, I think we need to put the reference number of FAS 32 as well. Now, why we are doing this? We are saying that if there is a loss which pertains to other than equity account, other than owner's equity, that loss or gain attributes to the investment account holders or other participating stakeholders, so it must be taken to them. If you don't do it, it will be injustice and it will not be Sharia compliant. Now, coming to the portion related to the owner's equity, if it is actually a short-term asset, short-term transaction, the asset is of the short-term nature, like inventory or others, in those situations, any gain or loss is a current gain or loss. It needs to be taken to the income statement. If the loss is long-term, like asset is long-term nature and loss is to be appearing in long-term, then you will see whether the loss or on this disposal or transfer to the investment to the investors in form of Sukuk holders, you need to check if it is because of impairment or it is without impairment. If it is because of impairment, then needs to be immediately recognized, and any amount over and above is just a margin. So that margin does not need to adjust your income statement to the income statement or the balance sheet. Rather, that loss element will be kept in the even gain element, because in some situation there can be gain element also. So the gain element or the loss element both will be kept, loss over and above the impairment, and gain whatever it is on the long-term asset, that will be kept in the equity and it will not be immediately accounted for. It will be amortized over the period of Sukuk or the life of the asset. I think we have one comment here. Brother Umar Al-Alusi has a question. Assalamu alaikum. In terms of consistency and comparability between AOFI and IFRS, if these provisions control optional switching between two standards by practicing candidate as may lead to different accounting treatment, especially with redemption or valuation. As per our, the problem is, I don't think you can keep both the options open. AOFI standards say that when we have a clear requirement in our standard or in a similar standard, you need to follow us. If we are silent on some matter, only then you can switch to IFRS. So if we have AOFI available, then switching to IFRS is not allowed by us. That is our approach. We believe that IFRS is a very good set of standard. They have very good quality, but they are primarily for conventional, not for Islamic. And they do not consider the true nature of Islamic. That is the problem that we are having. Okay. Okay, so the next is about subsequent measurement. Unless contrary to a specific requirement of this standard, the resulting assets, liabilities arising from the execution of the contract or contracts for the Sukuk issuance, movement therein, and the resulting revenues, expenses, profits, and losses shall be measured and accounted for respectively according to the nature of the contracts in line with the requirements of relevant AOFI FASs It should be relevant AOFI phases. Sister Sarah, phases applicable to such transactions. The revenue and expenses shall be recorded according to the nature of the contract. That is, each head of revenue and expense shall be recorded separately in the financial statements of the institution. This we are talking about the on-balance sheet. Presentation and disclosure. In respect of on-balance sheet sukuk, an institution shall consider the following as a minimum disclosure requirement: principal terms and condition of each significant sukuk issuance in case of insignificant multiple issuance or tranches of similar characteristics on a combined basis, and a clarification with regard to the attribution of ownership of such assets. Any receivable and payable between the institution and the SPV shall be included in assets and liabilities according to their nature. And appropriate disclosure in line with the requirements of relevant AOFI phases, including the underlying asset of each sukuk issuance, as well as sukuk tap commingling and combining of underlying assets, subject to relevant Sharia principles and rules. Sister Saira, I think for sukuk tap, we need to find a better wording. Okay, I'm not clear about this wording. Just make a note of it. Any reserves, including profit equalization reserve, investment risk reserve, revaluation reserve, etc., and distributed surplus and distributed performance incentives, receivable or payable, and other contractual balances shall be adequately accounted for the and disclosed according to the contractual terms. One-time or time-to-time transfer of own asset to sukuk holder, replacement of asset in line with the requirements of relevant AOFI FAS. It should be respective AOFI FAS, and we need to change the reference to the new one. It should not be relevant AOFI FAS. It should be respective AOFI FAS, and it should be. We should create a reference like presently FAS 21, but the new one is becoming applicable. So maybe we can directly create a reference to the new one. Carrying value adjustment and amortization of gain, if applicable, revenue and expenses according to the nature of contract. That is, each head of revenue and expense shall be disclosed separately, even if they are merged or netted off and classified according to their nature. So the full disclosure on this part is needed. The agency commission or management fee, including fixed and variable fee, duly presented as a part of fee and commission income in line with the respect of such income. Transaction costs incurred duly recognized as expense as and when incurred, except for the expense except for to the extent reimbursable by the counterparties. An institution shall also follow the presentation and disclosure requirements in line with the in its financial statement in respect of such instrument as applicable to similar instruments and transactions, particularly considering the disclosure requirements of FAS 1. So you need to follow the respective. I think we need to create a reference to relevant AOFI phases as well without putting the reference. But I think we should say that, Sister Sarah. Just make a note of it. Now coming to part 2. We were talking about right now on balance sheet assets. Now we are coming to off balance sheet sukuk. Sukuk shall be classified as off balance sheet and accounted for as such if and only if they meet the criteria provided in paragraph 35. Now, this paragraph 35 criteria needs to be read with I think this one need to be aligned with the new control standards, Sister Sarah. Just make a note of it for alignment purpose only. In these sukuk, the role and or involvement of the institution with regard to the underlying asset or business is primarily that of manager or agent or user, that is in a fiduciary capacity only. And when the control entailing risk and reward incidental to ownership with regard to the underlying asset is with the sukuk holders. These may include the following: whereby the principal accounting defined by respective AOFI FAS for such or such products as the instrument and structure used for issuance of sukuk specifically require an off-balance sheet account treatment, for example, al-wakala bil-istismar or restricted mudarba. Whereby the principle provided by the conceptual framework with regard to off-balance sheet items are met irrespective of availability of a specific treatment of the accounting of the asset or the structure defined by a particular AOFI FAS. So these are the conditions when you apply off-balance sheet accounting. So most common form of off-balance sheet sukuk that we feel that should be there and which is not there is al-wakala bil-istismar, which is quite big in number. There are situations where you can even have a restricted mudarba or unrestricted mudarba, but according to the new control evaluation, like the table particularly that I'm referring to in the control standard, there might be some situation that even an unrestricted mudarba may have more characteristics of a restricted mudarba and on off balance sheet asset. So even that might need to be considered in line with the requirements of that table, and that's where I would request our team to make a clear reference to that table in particular. There is a rebuttable presumption that Sukuk structures based on al-wakala will istismar if not commingled with quasi equity and restricted mudarba etc. will meet the criteria applicable to off-balance sheet Sukuk subject to following conditions. A, the institution does not control the asset of business, and B, either the title to such asset of business is transferred to the SPV with all legal requirements, or otherwise there is strong ring fencing enabling direct access of the Sukuk holders to the asset of business, even if only in adverse scenarios, for example, in case of default by the institution. There exists substantial evidence that the principal terms and conditions of the structure meeting the criteria mentioned above are actually implemented. So this is the situation that these will meet the criteria in most situations. Restricted mudarba and wakala. The earlier standard was also addressing about the ijara according to the FAS 8 treatment, but now FAS 8 treatment is no more applicable and FAS 32 treatment is applicable. So we will not be referring to ijara as off balance sheet by default. Ijara will be on balance sheet by default, but not as owning the asset, but as owning the user. Derecognition of assets. An existing asset, including combination of assets of business underlying the Sukuk instrument meeting the criteria for off-balance sheet accounting, shall be derecognized when the control is transferred to Sukuk holder. Gain or loss on derecognition, that is the difference between the carrying value of the asset and the sale consideration, shall be recorded as gain or loss in the period in which such sale is consummated. Now, I believe with this derecognition part, I have answered some of the queries that were earlier received. So derecognition of asset and recognition of gain or loss in case of on balance sheet, we have covered both of them. The difference is in case of off balance sheet, any gain or loss on derecognition goes to the income statement immediately recognized. In case of on balance sheet, we have different situations. For current items, immediately recognized. For non-current items, to the extent of impairment, immediately recognized. To the extent of not impaired, to be accounted for in the owner's equity. To the extent of the ownership that relates to the investment account holders or other participatory investors, that also immediately recognized. That is the summary of the recognition and derecognition part. Recognition of income and expenses of Sukuk. The revenue and expenses shall be recorded according to the nature of contract. That is, each head of revenue expense shall be recorded separately in line with the statement of the financial statement of the institution. Income for derecognized asset, even if they are under management, shall not be recognized as income of the institution. Now, this is an important part, that if you derecognize an asset, then its income will not come to you. Only the wakala fee or the mudarib share will come to you, including the variable and incentive part. Presentation and disclosure. In respect of off-balance sheet Sukuk, an institution shall consider following as minimum disclosure requirements: principal terms and condition of each significant Sukuk issuance in case of insignificant multiple issuance or tranches or similar characteristics on a combined basis, and a clarification with regard to attribution of ownership of such asset. Any receivable and payable between the institution and SPV shall be included in assets and liabilities. Appropriate disclosures of the underlying assets, reserves related disclosures and their movement, securities, cash, or other assets held on behalf of Sukuk holders, etc. One-time or time-to-time transfer of own asset according to the respective standard. Here also we need to update the link because the new standard is issued. Gain or loss on derecognition of assets of business as applicable. Revenues and expenses according to the nature of contract to be identified properly. Agency commission or management fee, including the mudarib share. Sister Sarah, I think we need to mention about mudarib share in this one and also in the other one. So mudarib share also, okay? Including fixed and variable and incentive. I think whatever we have mentioned in the new standard, I think based on that, we need to align the wording here. Transaction cost incurred duly recognized as an expense has been incurred, except to the extent reimbursable by the counterparties. Then we have the requirement of the respective product, that requirements of the respective product according to the respective OFI standards, and the requirements of FAS 1 will be still applicable. The effective date of the standard is proposed to be 1 January 2025. This is with some early adoption is encouraged. Maybe we would love to have your comments with regard to the implementation date as well. There is a very important transitional provision, and that transitional provision is saying that if you have an asset that is already issued, so it will be applicable on the all new transactions. And if the remaining period till maturity is not more than 2 years from the date of financial reporting, then the old old Sukuk do not need to apply this requirement. You can just mention that this transitional provision is applicable. So you don't change the accounting of Sukuk which have less than 2 years of implementation maturity from the date of implementation date of this standard. So if the substantial period is completed, for example, it is a 5-year or 7-year Sukuk and only 2 years are left, then in that situation you can continue. But if it is a 3-year Sukuk and 2 years are left, then it is not the substantial period till maturity. So you need to apply the new standard. So in a nutshell, a little bit flexibility will be available for the already issued old Sukuk, which are already in place and have less than 2 years of maturity. But if they have like 5 or 10 years to maturity, then obviously you will have to do that. And this amendment to other standard part we have discussed already. So with that, I stop here and will take the questions because we are ending the time is ending. We are just reaching the conclusion. We have 4 minutes left. Let me see how many questions I can respond to. Okay, now I think let me go to the initial questions. Brother Omar Al-Lulusi, you had first question about impact on investors' interest, how it happened, and so how it will be on balance sheet, off balance sheet. I think we addressed all of it, and I discussed about the governance part already. So I believe that most of your issues are answered. Brother Sheikh Muhammad Isa is about his issue is about if the Sharia compliance is having a sukuk underlying on balance sheet on the SPV. This can be done whether by sale undertaking, legal transfer of asset from the originator to the SPV. Am I correct? This is because some jurisdictions the sale of asset to the originator to SPV isn't legally allowed. For us, if the title is transferred as per Sharia, we consider it transferred for accounting purpose. If title is, because for transferring the ownership, not the title, ownership transfer is the condition as per Sharia. So at times Sharia allows that because of the legal restrictions or because of the taxation issues or certain other issues, the originator can hold the asset under an agency capacity on behalf of the holders. So that still does not mean that he retains the ownership. So from our perspective, if the ownership is transferred, then you need to apply the Sharia standard and the accounting standard as per like this. AOFI conceptual framework of financial reporting has addressed some issue related to the substance over form and the situations where Sharia considers substance and form to be different. Anybody who is interested may have a look at that section in the conceptual framework. Thank you very much, Brother Sheikh Muhammad Isa, and sorry for keeping you on hold because your question was to be answered towards the end. We have comment from Malika bin Al-Kama. What is the difference between hybrid pool sukuk and variable rate redeemable sukuk? I think that question is more about the structured part. I think hybrid sukuk I have explained very well because it was more related to this one. I've discussed it at multiple stages. Variable rate redeemable sukuk can be based on different structures. So there can be completely different things. So variable rate redeemable sukuk can be based on ijara. They can be based on mudarba, musharaka, wakala, and other structures. Unfortunately, the time will not allow us to go in much detail about it. But inshallah, in the upcoming public hearings, we can try to discuss more about the structures if the time permits. Muhammad Bilal Nabizada would like to kindly ask what adjustment are made to the balance sheet when sukuk were mature or redeemed. This is an important point. I think I would like to take a note of it because the redemption part of the accounting or the asset acquisition back part is not addressed very well in this standard. We understand that this is addressed in the respective product structures. You cannot put it at one time. So for example, if there is a ijara asset that comes back to your structure, to your asset, or if there is a different type of a structure that results in different adjustment, that will all be done according to the underlying structures. But since your point is very valid, Brother Muhammad Bilal Nabizada, I would suggest our team to take a note of it, and maybe we need to explain this thing in the basis of conclusion that why we have not addressed this issue, because all sukuk are based on different structures, and the acquisition of asset or the transfer at the end of the sukuk structure may be taking different forms. So from that perspective, what happens We will see and discuss in the working group and the board if there is something needed to be written in the standard. If it is, yes, we will add it. If it is not, then we will just try to explain it how it will take place according to the respective standards. Thank you again very much, Brother Muhammad Bilal Nabizada. Thanks for being with us. Sister Malika Minalkama has another comment. Sir, can Originator use orphan structure in Sukuk issuance? Obviously, we have seen some orphan structure-based Sukuk issuance, and actually, ideal situation is that Sukuk should always be orphan structure. This is my personal humble view. But yes, we can use it. From our perspective, even if you control the SPV and there is no, the orphan structure is not there, rather a controlled structure of the SPV is there, but still the SPV holds the asset on behalf of the Sukuk holders. And that is where we believe that control still does not establish. So while it's not an orphan structure, but it's still, as per Sharia, it becomes close to orphan structure. And that's why for us, we do not control, we do not consider control by the way of originator controlling SPV. There are governments who have their own SPVs to create Sukuk. We don't consider it to be control because that SPV is holding the asset on behalf of others. So while SPV is being controlled, but the structure of the instrument is done in a way that the instrument ownership and ownership rights and risk and reward incidental to ownership attribute to the Sukuk holders. Thank you very much for a very good comment. We have comment from Sister Halima Miftah. Assalamu alaikum. What is the future of digital Sukuk? Thank you very much. It's a very good comment. Not related to today's discussion. We believe that digital Sukuk are the need of the time, and we promote. We have worked on crowdfunding, Islamic crowdfunding. We believe that crowdfunding models. We issued we issued a governance standard on crowdfunding. We have picked up some of the projects related to fintech, and digital Sukuk, we believe, might not need a separate standard. It may be done by combination of our governance standard number 12 on Sukuk plus the crowdfunding requirement. So maybe we'll come up with a short standard on that, or maybe we'll just refer to the requirements of the Sukuk standard, Sukuk governance standard, as well as the governance standard on crowdfunding. Accounting for digital Sukuk, we believe, will exactly be the same as per this standard as we have done. Brother Idris Abdul Hamid has a comment. Please, are we going to have this document shared after the webinar? Brother, this document is exactly the same as the standard. The standard is already shared with you. It is available on UFI website in PDF format, and this presentation is normally not shared. The PDF is shared. Sister Noof, can I request again? I know that you shared it in the beginning of the session today, but please share the link to the PDF version of the standard again for the benefit of the participants who have joined in late. This is always available on our website. You can just do a Google search, but our Sister Noof or Sister Hora will be providing you in the chat window. Thank you very much, Brother Idris Abdul Hamid, for being with us. And thanks, I can see Sister Noof shared it again. Now, Brother Shad Ali Yaftali has a, can I share presentation slides to our email address? No, presentation slides we don't share. We just share the PDF version. So please, PDF versions will be provided to anybody of you who want the PDF, the standard. Just as a matter of policy, this is exactly as the standard, but we do not share it as a matter of policy. Thank you very much. Brother Najibullah Faizi has made a comment with regard to tradable and non-tradable, and Brother Najibullah, I feel unfortunate that you missed the session. Sister Zahra, Sister Saira and Hora, how many public hearings are left on this standard? I think one more or two more?
One in Arabic.
One in Arabic. English are complete now?
Yes.
Okay, so this is a bit unfortunate because we are completing the series. Maybe on the public hearing on the Sukuk Sharia standard, we can address this issue because the tradable and non-tradable issue is more related to the Sharia side. So as soon as we conduct the Sharia public hearing, you can keep in touch with our secretariat, and the public hearing of Sharia standard on Sukuk will be more relevant on this topic, inshallah. Maybe I'm sorry because I discussed this issue already, and it's already a few minutes above time. So with that, since I can't see another comment, I would like to thank you all, and I would like to pass it on to our Sister Hora to close the session. Thank you very much again, everybody, for being here with us, and thanks to the supporters for the event.
Thank you, Brother Omar, for the insightful presentation and Q&A session. We would like to thank UAE Banks Federation, all participants, and our colleagues here in AUFI. Inshallah, we see you in other public hearings on other standards, both in Arabic and English. Thank you all. Have a good day. Assalamu alaikum.